Not seeing a great deal of movement here, but Tom, as you point out, the story has been one of inflation rates coming down so far out of the German regions.
And that seems to be constraining these equity markets. A decided lack of conviction coming through from these futures. DAX futures pointing up by just 18 points. Here in the UK, the FTSE 100 looking to gain just 3 points. The CAC is pointing lower as we head to that open, Anna.
Yeah, pretty range-bound then. Seems to be the theme of the morning. Range-bound in terms of futures expectations, range-bound on some of the market moves we're seeing in sovereigns. We'll take a little break perhaps from that higher for longer theme, pushing yields above recent levels. That's what we had been seeing, of course, over in the US just yesterday. Interesting to point out what has been happening in Australia. We're seeing yields going higher there, a reminder of what happens when inflation resurges. So that's worth a note. We're just waiting for those European equity markets to come through. In fact, we seem to have a malfunctioning GMM this morning. So we'll come to you on sectors instead, because you have at the top of that board then, Tom, what is happening on European equity markets, which is not a great deal this morning.
It's not a great deal. We continue to wait, of course, for that Spanish CPI print. So when that crosses, we'll bring that to you as well. Really important in terms of how we think about inflation for the Eurozone. Across the benchmark, as you say, we are flat here in Europe. Again, there's a lack of conviction. There's a lack of direction, weighing up, of course, the higher oil price, but also those yields running up to back to those 2007 levels across US Treasuries yesterday. Yes, a bit of a breather in the bond markets today. Will the CPI print lead to money moving into Eurozone debt? Possibly. We also weigh up, of course, that decision by the Italians to push back their target in terms of getting back to that Eurozone or Brussels set target in terms of the budget deficit. Here in the UK, the FTSE 100 posting very, very modest gains. It was energy as a sector that gained yesterday across a broad market that was fifth straight day of losses for European sectors or European equities, and the losses were coming through from real estate and utilities, but energy did manage to post gains yesterday on the back of the higher oil price. That seems to be a theme that continues today. Energy as a sector gaining 0.7%. Basic resources also up 0.4%. Tech taking a bit of a hit. We know that Micron disappointed stateside as well with its projections around the demand for its semiconductors, so there's possibly a read across for the chip segment within Europe as well today. Tech down 0.4%. Yields a play there as well in terms of the drag on technology. You're also seeing some very modest gains across industrials. Financial services flat, banks are flat, utilities getting 0.3% after the sell-off yesterday. Another sector that jumps out, travel and leisure down 0.8%. So travel and leisure also taking a hit. We know that the higher rates environment is also a concern for investors with exposure to that sector. Anna.
Okay, let's get to some breaking news. We're just getting the Spanish CPI print coming across the Bloomberg terminal. So let's get to that then. So on the Spanish prelim September CPI rising 3.2% year on year. The estimate was for an increase of 3.3%. So that's a little lighter than was expected. It is still a tick up from the 2.4% prior up to 3.2. But if you're looking for confirmation of inflation coming back down and having peaked, and the Spanish story is a little different. It's been lower and a little more volatile around those lower levels. But we are seeing on the core CPI print a number of 5.8%, which is lower than the 6.1 prior and lower than the 6.0% survey number. So if you're looking for something that goes alongside and complements what we've heard from North Rhine-Westphalia this morning, then perhaps that is in line with that thinking. Quick look at what's going on GMM then, as we just sort of give you that fuller picture on the markets. We had European equity markets opening, as Tom was saying, pretty flat this morning. Not a great deal of movement there. In terms of the bond market story, really interesting to see some of these bond markets then yields going higher once again. And in fact, we've seen a turnaround in treasuries just in the last hour or or so. They had been at the start of this program. We had been taking a break from that higher yield story with yields coming down. Now we go higher on treasuries. The yield on the US 10-year, 4.61% right now, and commodities continue to climb, as we've mentioned a few times. 97.22 on Brent this morning. Let's get to Sophia Holter-Acosta, who joins us from the Markets Today blog, and let's start with that Spanish CPI print. Sophia, I was taking I was possibly looking for some confirmation bias, looking for something that went along with the coming off highs story that we've had from Germany. What stands out to you on Spain?
A word of caution, I think. I mean, it is one of the slowest inflation rates in the Eurozone. It is good news, obviously slower than expected, but the Bank of Spain actually last week in its macroeconomic forecasts did say that inflation would probably quicken faster this year than they previously thought, and that's because of oil, another big theme of the day. So I think I'm going to link in those two things. Yes, there are signs of kind of slowing inflation in the euro area, but we're not factoring oil at $100 a barrel. And you know, the person that you were interviewing earlier saying that that's actually we're basically already there. So if we do get more supply constraints and that price goes higher, what will happen to inflation in the fourth quarter? I think the market is not quite there yet in terms of pricing that in.
Yeah, and interesting that the euro, which is showing on the screen, not responding to what I was mentioning, the core print coming in lower than expected, but instead perhaps just reflecting the fact that we've seen a big jump up confirmed, even though it was expected, but confirmed in this data.
So Brent currently trading at $97 a barrel. To your point, Sophia, up 0.7%. It's not a question of if, but when, for many, it gets to $100 per barrel. There's a obsession, of course, the central bank obsession with that core component of inflation. But for consumers, it's the headline, it's gasoline prices, and it's the impact on their cost of living.
Yeah, I know central banks like to strip that out, but it's actually a hugely important factor when you think about the strength of the consumer. And I think going forward in the US, in Europe, in the UK, the consumer story is really important for where growth will come from. You know, we are seeing signs that that's starting to crack, especially in the US. So where is oil going to go? I don't think, you know, any of us are qualified to guess. I don't think anyone is qualified to guess on that. But the fact that we are getting supply constraints, not just in the US, with those reserves at crisis levels, as one person was saying, you know, Valdano Mahari, she was saying that you have a market which is very tightly strung right now and almost on the verge of panic. I mean, I don't want to panic, Tom. I don't like panicking. But if you do have Russia also and Saudi Arabia, you know, really making it difficult on the supply side, and you might get a ramp up in demand, then where will oil stop? I think that's a question not just for the market but also for policymakers.
Yeah, interesting, and a focus on supply for sure. Evergrande in focus as well. Its units suspending trading in Hong Kong a day after, of course, we heard about what had happened to the property giant's founder concerning the police. What do you make of the latest news flow, Sophia?
I was actually looking at the price chart on Evergrande. It was suspended for about 18 months before. So this is a stock. It's a penny stock, and it was the price is about 32 Hong Kong dollar cents, and when you divide it by 10 at current exchange rates, that's about three pence. It's really kind of it's a stock that's fallen. It fell 80% on the news already this week. So it's a really distressed company. Its dollar bonds are trading below 5 cents on the dollar. The fact that it's suspending trading is just essentially to stop people from trading. But it's a very, very illiquid company. It does have kind of more highly valued units, and its EV unit was once one of the most valuable EV stocks in the world.
Long gone are those ambitions.
Long gone are those ambitions. But essentially it means if you want to short this stock, it's impossible. If you want to get out, your window might be closed for another 18 months. The latest news really suggests that this is a company that Beijing is not going to help. It's not going to bail it out. If there are any doubts remaining about that, I think the news that the founder is under house arrest really kind of brought reality home.
Yeah, it's certainly a cautionary tale for other developers, isn't it? And as you said before, the priority for policymakers in Beijing will be to make sure those homes are actually delivered to those who have put down those chunky deposits on them. Sophia Holter-Acosta, thank you very much indeed, of course, with the latest on oil, inflation, and what is happening in China's property market. From our Markets Today blog, you can get more from the team on the front page of the Bloomberg UK website by typing TLiveGo on the terminal. Here's what else we are watching in markets today. We've had that Spanish CPI then just a couple of minutes ago. Later, we're going to get a German print rounding out the picture out of Europe's largest economy. That's at 1 p.m. UK time. At 1:30, we get a third reading of second quarter US GDP. And at 9 p.m. UK time, Fed Chair Jerome Powell hosts a town hall. Anything he says, of course, about the strikes, about a potential government shutdown and what that could mean for the Fed's thinking will be scrutinised. And finally, Nike reporting after the US close as well. So touching in on the retail space and the strength of the consumer in the US.
OK, so we're back into earnings stories. We are dealing with a number of corporates on the move here in Europe. Let's get you details. Coming up on the programme, AMS Osram sinks to the bottom of the stock 600 on its refinancing plans. What is it planning to do? And you can see what that's done to its stock, down by 21% today. Details shortly. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg.
Happy Thursday. This is Markets Today. European equity markets currently flat as we weigh up higher oil prices and continue to focus on the bond story, given that yields ran up to, 4.6 on the 10-year yesterday, 2007 highs. Let's get a check, though, on some of the individual stocks on the move with Joe Easton. Joe, what is jumping out?
So, Tom, we've got some big red numbers on the screen. Very exciting. AMS Osram dropping around 19%. This is the Swiss chip maker that does supplies into sensors and lighting, that kind of thing. They did an €800 million rights issue announced after the close of trading yesterday. So they're having to ask existing investors to buy more stock at a discounted price due to liquidity issues. And that is getting absolutely slammed. The worst stock on the stock 600 this morning, down close to 20% at the moment. The other big dropper is 888, the gambling company here in the UK, saying pretty much what Entain told us a few days ago, that they have seen a slowdown in some of their gambling markets, and also better than expected sporting results favouring the punters, so the punters winning more money, and that is hitting their profits. And we're seeing even Entain coming down further despite a 15% plunge on Monday for that stock. So really not a good couple of days for the bookmaker stocks here in London. Then a couple of other stocks that we were focusing on pre-market. Mitchell & Butler was one of them. The owner I'm hoping we're going to get that up. There we go. That saved me there. So Mitchell & Butlers, now this is the owner of All Bar One, but also Toby Carvery. Who doesn't like a Toby Carvery roast dinner on a Sunday? That stock up 4%. Sales gaining 10% in the last quarter, and some of their costs coming down. So energy, wages, all of that benefiting that one. And that is also boosting JD Wetherspoon, the biggest pub company here in the UK, up as well, alongside Mitchell & Butlers. At the bottom here, we've got Ryanair giving an exclusive interview to Bloomberg, saying that they will have to cut some prices in order to stimulate demand. And they've also been hit by some worries about Boeing deliveries, so that is weighing on Ryanair this morning. In terms of the ratings changes, H&M downgraded at Deutsche Bank. They upgraded it in January, but now say that there are sales declines coming for that company, and they don't expect them to be able to cut costs enough in order to keep that stock elevated. So Deutsche Bank downgrades that one falling over in Stockholm. On the utilities, Uniper was the one that Barclays said was overvalued. They're mostly positive on the utility sector over at Barclays, but they downgrade that one, slipping a bit. It was called a bit lower than that earlier, whereas Severn Trent goes higher, almost 2%. They say that the UK regulators will allow water bills for households to rise about 20% over the next 5 years, and that is good for companies like Severn Trent. And then finally, bpost over in Belgium, the delivery firm, that one gets its first buy rating in almost 5 months, and that one jumping about 5% at the moment. KBC positive on bpost, up 4.6%.
Joe, thank you very much. Joe Easton from our equities team with the latest on stocks on the move. Let's get a broader perspective on markets. Freddie Lake joins us, managing partner at Latitude Investment Management. Freddie, nice to have you here in the studio. Now, September's been a pretty tough month for stocks, a tough month for many assets, actually, bonds as well, but a tough month for stocks. You say ahead of our conversation, expected returns for stocks from here are low. Is it getting harder to find those stocks that have that margin of safety that you're looking for?
Yeah, the things we've been talking about to clients recently, margin of safety on valuation is the key one. And I think if you look at the US market on any kind of longer-term valuation metric, it's substantially overvalued. You know, people talk about 30%, 50%. And I'm not suggesting that has to happen in a crash quickly, but it does cap the return expectations for the next few years as you get some earnings growth and some derating. The key on the margin of safety point is that actually, given the focus on the sort of Magnificent Seven and the stocks that have worked so well in the last 10 years, there's actually an extraordinary number of stocks in the market that are trading inexpensively, have high returns on capital, but are being ignored by the market. Some are slightly more cyclical, a lot are still defensive, trading at half or a third of the valuation multiple. So our big thing is you don't even need to take an extraordinary amount of risk. You just have to risk missing out on this sort of final burst in the rally for this stuff to find other stocks. So there is margin of safety available within the market. And the other argument that we make is this concept of sort of safety of margin. You know, we've got energy prices going up, which we've talked about before. You've got wage inflation coming up, inflation in general. You've got interest rate costs going up, capital driving higher depreciation. There's so many calls on margin squeezing over the next few years. You know, we've had a very nice 10 years of just sort of steady margin expansion for most of these sectors. You've really got to believe in the safety of that margin to even get the earnings growth coming through. So those two things are really the key way we're looking at the market.
So beyond, and your scathing of the siren call of the Magnificent Seven, and the need to look beyond that, and you've outlined why you would want to do that. Where does that take you? What sectors? And is this the window to get exposure right now, or do you want to sit in cash for a bit before you get a little bit more clarity?
Yeah, so the way we phrase it to clients is we think it's highly rational right now to be moving out of those and saying, thank you, we've had a great run. 2022 was a warning shot across the bow. Let's not get exposed to that kind of risk again. And moving some of that capital out into other equities. We think there's value in other equities. So we would be doing that right now. I think timing markets is impossible. But you're dead right to point out that basically every decision in investing is a relative call. It's always relative. Do I take one of the Magnificent Seven on a 2 or 3% free cash flow yield, or do I buy something else on a 7 or 8% free cash flow yield, or do I take bonds at 5? Yeah. You know, that's the relative decision.
And are you out of all of the Magnificent Seven? Because I think we've had conversations.
We still have Alphabet.
You still do?
Yeah.
Why hold on to that one then?
Valuation, principally.
Okay.
Yeah, it's still trading closer to a 5% free cash flow yield at the moment, growing similarly to the others.
So it looks a bit more sensible than the others.
Sneaks in still on
Sneaks in, okay.
Yeah.
Let me ask you about, let's take us to the oil conversation, because you mentioned about the pressures on margins, and that's one of the things we're watching, of course. Oil is higher once again, 97.30. How do you think about investing, Freddie, in a world where oil prices are this high, perhaps stay this high? I don't know whether that's your view.
That is our view, absolutely, and I've written quite a lot about it over the last year and a half, 2 years since we started investing in oil stocks, first time in my career. We think it's structurally changed around the supply side. I'm sure you guys have talked about it on this show lots. The capital discipline from these guys, they used to, for 50 years, the whole oil and gas sector spent 100% of free cash flow on capex, and then actually they spent even a bit more and had to gear up their balance sheets. Now they're all returning 60, 70% of that free cash flow to shareholders instead, and that capital investment is just dwindling. So the growth potential for the supply side is very, very tight. And you can. I mean, the best way to think about oil prices, which are quite hard to predict, obviously, is to look at inventories in the market. And if you can already say that if the Biden administration hadn't sold down the SPR so much, oil would be 130 today. So you can already point to that level. And obviously, they may not refill it, but it's unlikely they sell the rest off. So the pressure on oil prices going higher is very strong. So the way you invest is you buy oil companies, first and foremost. They're incredibly cheap. They've changed. The supply side supports the long-term growth outlook. I think BP is trading on around a 30% free cash flow yield. So we were just talking about 2s and 3s and 5s. So incredibly cheap. And it adds to your portfolio diversification. One of the greatest risks is inflation coming back. And you can benefit from it in your portfolio.
And that's another stock you own, isn't it? BP?
BP and Shell.
Yeah.
When do investors kind of, they seem to have a blind spot in terms of the valuation gap then between a name like BP and a name like Exxon over in the US? When does that gap close, do you think?
Yeah, I don't know about that. The benefit to us as shareholders of BP is it's less expensive, so you have a margin of safety, and the capital return has moved to a large portion of buybacks. And so the way stock buybacks work is obviously the cheaper the share price, the more value you accrete for the long-term holder of the shares, the ones that remain. So to our mind, we actually prefer it for the next few years staying at a discount. We're not looking for some quick catch-up. I think it's there. Well, it's pretty clearly there for two reasons. The principal one is the move to sort of electrons from hydrocarbons, so moving into renewables. And
is that real? No sense of guilt, Freddie, that you're investing capital in a company like BP?
Well, that's why they're undervalued. That's my point. Because they're moving more into renewables, they're getting a lower multiple in the market. Whereas the people who are buying into Exxon, and the Exxon CEO has been talking about this on TV and elsewhere, we are just going to stick to oil and gas. And so we are investing in the business which should have less guilt and actually accretes more value through their buybacks to us as shareholders because it's cheaper.
Okay, relative value, relative guilt. Freddie, thank you very much indeed with the analysis there. The call on tech, relative value, of course, and how to look for businesses that can preserve that margin in this challenging environment. Freddie Lay, of course, managing partner at Latitude Investment Management. Coming up, US beauty and fragrance company Coty launches an offering of 33 million shares as part of its plan to list in Paris. We're going to get the details next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 8:23 here in London. So European equity markets 23 minutes into their trading day this Thursday and showing some modest gains, actually, as the US futures point just a touch higher this morning. US beauty and fragrance company Coty has launched its offering of 33 million shares as part of a plan to list on the Euronext Paris. The move is a rare example of an American company crossing the Atlantic to seek out investors in Europe. Sweta Gopinath, our deals reporter, joins us now. And we should point out, of course, it's listed in the US already, has been for a while, but this is adding another listing venue. What does this listing mean then for Europe?
Yeah, as you were saying, it's a rare example of a company actually moving from the US to Europe. We haven't seen much of that. We were talking a couple of weeks ago about Arm leaving London. There was a lot of sort of distress here about Arm leaving London. We've had other examples of that historically. Spotify, probably the biggest European startup ever, listed in the US and not locally. On running shoes, which are very popular now, backed by Roger Federer, a Swedish company, listed in the US. So there's a history of sort of European companies listing in the US. Few have actually come back. Coty's called it a return to sort of the historic home of beauty. There's some reason for them personally, for them specifically to list in Europe.
So is it specific to their story then, or are we really kind of facing a flood of US companies looking to list in Europe? And why pick Paris for Coty?
Yeah, I mean, Paris has this sort of ecosystem of luxury stocks. So LVMH, Kering, which owns Gucci, Hermes, L'Oreal, which is sort of a peer to Coty. They're all listed in Paris. So Paris has like an ecosystem of analysts and investors who actually understand the industry, who understand the trends and the industry cycles and whatnot. So that's helpful, you know, having sort of that community of people who actually understand the business.
And I suppose that makes sense because the argument for going to the US for tech stocks has always been that they know how to value tech stocks. So maybe the same applies in Paris around luxury.
Exactly. So Paris is now trying to position itself as sort of the home of beauty and luxury. But yeah, I don't think we're going to see a whole flood of US companies listing in Europe. This is a one-off, unfortunately.
Sweta, just briefly, given you're from our deals team, are you seeing a pickup? Is the momentum starting to pick up consequentially across deals now?
Yes, especially for IPOs. We've seen a bunch of listings in the US. We're seeing a couple in Europe. We have Short Pharma starting to trade today in Europe. I think it just started trading, in fact. Yeah, we've had next to no IPO activity for like 18 months, so that's picking up. Deal activity, M&A particularly hasn't sort of taken off, but yeah, there's a steady sort of flood of deals. It's better than it was earlier this year.
Okay, helpful context. Sweta, thank you very much indeed. Sweta Gopinath, our deals reporter, of course, on Coty and the broader IPO and deals market. Coming up, Italy risks a budget battle with Brussels. Nice alliteration there, guys, after delaying its deadline to meet the EU's deficit limit by a year. The details are next. This is Bloomberg.
Venture capital, It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. US oil stockpiles fall to critical levels, sending WTI crude to a one-year high and Brent nearer to $100. Germany's bellwether state sees a softening in price rises, with national numbers expected to follow suit. But Spanish CPI accelerates for a second month, highlighting the difficult job facing the ECB. Plus, Italy's government delays its deadline to meet the EU budget deficit target by a year, setting up a potential confrontation with Brussels. So, Tom, lots to talk about when it comes to the macro. A lot of inflation data very much in focus in the Eurozone today, from various parts, from Spain to Germany. In terms of the broader stock market picture, not a great deal of conviction, it seems, this Thursday.
A lack of direction still on this Thursday after 5 straight days of losses for European stocks, looking for some kind of catalyst, as you say, to either take a convicted view on whether you get further downside across these markets or whether there is something that can lift the mood. And so far, the inflation data has failed to do it. Yes, slightly softer, of course, in some parts of Germany. The Spanish data broadly in line with expectations. You're seeing gains across the benchmark then, very, very modest gains of just 0.1%, and you have to expect there's going to be a bit of volatility and a bit of movement in the session this Thursday. The DAX currently adding just 15 points over in the UK. Here in the UK, below 7,600 now for the FTSE 100. A loss of 5 points, just down about 0.1%. And let's see how the sectors are breaking down then, because real estate was under pressure yesterday. The biggest losses coming through for that sector. Utilities also took a big hit. We're continuing to focus on the technology story, given the run-up in yields, the concerns there as well about the semiconductor space flagged by the likes of Micron over in the US. So across your sectors, the biggest losses now, amongst the biggest losses coming through from travel and leisure. Look at that, a hit of 1.2%. We know there is concern from this industry about what these higher rates are doing to the consumer in terms of that demand for travel and some of the leisure part as well of that component. Utilities picking up some of the losses of yesterday, pairing some of the losses of yesterday, adding 0.3% in the session so far today. Energy is gaining 1.2%. Yes, we seem to be closing in on that $100 a barrel level for Brent. Eddie van der Voort from our LM Live team says it's unlikely, though, to hold above those levels if indeed it does break above $100. Energy, though, is a sector currently gaining 1.2% on the back of higher WTI and Brent. Basic resources also up. Iron ore and copper prices have picked up in the session today, gaining 0.6%. And those are the standouts. Technology taking a bit of a knockdown, 0.2%. Broadly, then, across your benchmark, Anna, very, very modest gains of about 0.1%.
OK, yeah, modest gains. And it's really interesting to see that travel and leisure move. It's easy to think that that's all about higher oil prices and it's travel stocks going lower. Just clicking into it, it's actually a lot to do with the leisure stocks that Joe Easton was talking to us about earlier on. Some of those gaining gaming, those bookmaking companies listed here in London, going a bit weaker. Let's talk about the macro picture in Italy then, Tom. Italy has delayed meeting the EU's budget rules by a year, risking a confrontation with Brussels. Italy is not the only country struggling to meet EU fiscal rules, but the plan underscores the challenge Prime Minister Giorgia Meloni faces in balancing, on the one hand, tax cut promises that she made, and on the other, souring economic growth. Joining us now from Rome is Bloomberg's Alessandro Migliaccio. Alessandro, good to speak to you. So the Meloni government has come up with a relatively cautious budget then. Would you describe it as that? What were the takeaways?
It is actually, yes, as you say, a relatively cautious budget. There's no wild spending, but this is, after all, a political government. They need to keep some of the promises that they made to voters. They need to, protect some of the lower income families. They promised to do that from high inflation. They promised some tax cuts. So that's money that they need to spend. At the same time, economic growth is lower. It's happening all over Europe. Germany's slowing, and Germany is one of Italy's major trading partners. So the result is that they can't get everything done that they had hoped to do. And so they're just going to have to wait. I mean, the finance minister told us in the press conference in Rome yesterday, Brussels will just have to understand. So they're not going to be able to get to that 3% level until 2026. The Stability and Growth Pact is not going to be active until next year. It's going to come back next year. And they're renegotiating, how flexible or not it will be, but it's certainly going to be a problem when Brussels goes to look at those numbers and sees that they're not even close to 3%.
Yeah, I like that line. Brussels will just have to understand, as though it was as easy as that. In terms of the yield premium then, and how concerned investors should be, I'm looking at the spread of the BTP 10-year over the German counterpart, and it's about 200 basis points, 4.8 on the Italian 10-year versus 2.8 on the German 10-year. How concerned should investors be?
Well, they're a little concerned because throughout the month, it's gone up about 30 basis points. It's nearing that 200 basis point level, but not too much because they made an effort. I mean, it is cautious in that we haven't found anything, any wild spending. So they're trying to do the best they can. They should just keep an eye on those debt levels because, the consequence, obviously, of high deficit is that it's going to impact your debt. And that's something that's a concern with a country like Italy that has mammoth debt levels.
Yes, and closely following on from a conversation about Italian debt, you don't go far before you bump into some Italian banks, Alessandra, so let's go there. And I know that there's an effort to consolidate, to produce a third big Italian banking business, and I wonder what the latest is on that. We covered this around this time yesterday with some of our reporting suggesting that was going to be what was being planned.
Yes, and the finance minister yesterday confirmed that that is an option and that's something that they are looking at and they would they would approve of. Of course, it's not all up to them, but it's interesting because it would change, the banking panorama. So it would be a very interesting development in the Italian banking industry, which needs consolidation. It's needed consolidation for years. So if they could pull that off, we'll have to see who can partner up with MPS. MPS is Monte Paschi di Siena. It's the troubled bank that's been giving the government a headache for years. So that's something definitely that markets should be looking at.
Yeah, historic as well, of course, for the banking sector in Italy. Alessandro Migliaccio, thank you for the context, of course, out of Rome in terms of this potential standoff between the government and Meloni and officials in Brussels over this jet to GDP, and of course the banking sector changes as well being proposed. To technology now, though. Meta Platforms introducing artificial intelligence features as its apps, or to its apps, that it claims will give the company's 3 billion users an experience akin to OpenAI's ChatGPT. CEO Mark Zuckerberg says the innovations will be rolled out across Instagram, Messenger, and WhatsApp.
But our view is that people are going to want to interact with a bunch of different AIs for the different things that you want to do. And I actually think that over time, a lot of you are going to want to make your own AIs to advance individual goals that you have, whether you're a small business and you want to interact with customers, or if you're a creator and you want to engage your community, or whatever it is that you do.
Okay, Mark Zuckerberg there, of course. Meanwhile, Meta's Global Affairs President, Nick Clegg, told Bloomberg Originals more about what to expect from AI on Meta Platforms.
AI systems not only recommending content, but now increasingly generating content. So one of the things that we've been working on is how to make sure that people can distinguish between the provenance, the origin of something which is, generated by AI rather than generated by human beings. So we will have visible, clear watermarks on the photorealistic imagery that people will be able to use in something called /Imagine, which is our photorealistic tool integrated into Meta AI.
Okay, Nick Clegg there on how Meta is integrating AI into its business and its platform, also, of course, formerly Deputy PM here in the UK. Anna.
Okay, coming up on the programme, we'll talk about Germany and the health sector, where they converge. Siemens Healthineers joins us, the CEO, Bernd Montag. That conversation shortly. This is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today, 41 minutes into our European trading session. Fairly flat overall on European equity markets, just up 0.1% on the Stock 600. London underperforms a little bit, despite that higher oil price, which you might have thought would send some of those oil majors higher. But that's the picture we have right now. London underperforms, a little bit of better performance coming through in Paris. Now we've had the first regional print of German CPI from the bellwether state of North Rhine-Westphalia. Inflation fell to 4.2% on the year in September. Softening prices across Germany would reinforce markets' views that the ECB has reached its terminal rate. So far, so simple on the macro front. Sticking with Germany, let's get to Bloomberg's Oliver Crook, who's in Berlin for us with an important conversation. Oliver.
That's right, Anna. We're here in Berlin. I'm with Bernd Montag. He's the CEO of Siemens Healthineers. Who better to get a health check on the German economy with than the CEO of the company? So your company is, and your business is evaluating health. How do you evaluate the health right now of the German economy? Is Germany, as the many pessimists say, the sick man of Europe?
Well. So I'm very happy with where we are as Siemens Healthineers. I don't really like this talking the German, whatever the location or the famous Standort Deutschland down. We are happy. We are a global leader. 20% of our workforce is in Germany. 8% of our business is in Germany. We are a #1 in the United States in terms of market share, in Europe and in China. So it's possible to run a successful business out of Germany. But on the other hand, we are also a very global company.
And so, but you think that the pessimism is maybe a bit overblown right now in Germany?
I think so, yeah. I also believe that when you double-click on what is happening in the country, and when you look at companies like us, and we are not tiny, I mean, when you look at the combination which especially medical technology offers, it's very much about knowledge. It's not very resource intensive. There's a lot of opportunity.
And on that subject, it's not on all of those things. Do you think that Germany, the innovation and the sort of companies that come out of Germany could look more like Siemens Healthineers, less energy intensive, and BioNTech and healthcare, those kinds of innovations adding to the economy rather than, say, Volkswagens? You are, by the way, within 5 billion euros of the Volkswagen market cap as of today.
That's good to know. But we don't compete with them,
Of course.
But I really believe, that what we are doing, what healthcare companies are doing, what biotech companies are doing fits extremely well to Germany. It is about using the strength, in science, in engineering. And it's more about knowledge than about exploiting resources.
And the question on that is AI, right? This is something that everyone is talking about. There's some perhaps more tenuous, imaginative ways that businesses suggest that they will deploy it. For Siemens Healthineers, there's a very clear line in terms of processing information, medical information, images, all this sort of thing. How do you think AI and Siemens Healthineers, how is that going to save human lives? How is that going to change healthcare?
See, I think there's, when looking at the 3 biggest challenges in global healthcare, there's the rise of the non-communicable diseases. This is like cancer, cardiovascular disease, stroke. There's more and more staff shortage, and there are billions of people who don't have access to care. We will not solve this by training more and more physicians and putting all the knowledge and all the necessary work into their brain. So AI is a fundamental driver for making healthcare available, make it more precise, taking the routine work out of the precious time of physicians. So the ultimate goal or the ultimate recipe is the combination of the human augmented by AI.
And do you think there are any risks with that, just because certain biases start to collect within AI and doesn't have necessarily the creative functions that the doctor or data analyst would have?
I think there are certainly risks, but on the other hand, I think the risk of not using AI and not putting all efforts into making it part of reality is much higher than the risk of certain biases, which we today also have, but in the human mind. Right?
And your business is really attending to human ill health. So in some way, you have a very clear sort of roadmap about more broadly where human health is going. What do you see there? Where do you see sort of sickness developing? What are you targeting, and what are you trying to solve now?
I mean, as I said, the big topic for us is the non-communicable diseases, and I take cancer as an example. There's a growing cancer burden. We have done the combination with Varian, or acquisition of Varian. And by the way, talking about German economy, so this was a German company buying a market leader out of Silicon Valley, so it can't be that bad. But it's a very, very nice combination. So it is about finding disease earlier with our imaging technologies. It is about then using AI to guide and select the right treatment, and then use technologies to treat cancer exactly where it is. So this way of going towards precision medicine, which is a big term in medicine today, finding the right treatment for the right patient at the right time, is basically what our technology is about.
And I was hoping to enlist you to help translate something for me. In sort of politician vocabulary, we talk about de-risking a lot right now, de-risking from China. In CEO vocabulary, what does de-risking mean? What are you thinking about in terms of China? Do you see the risk of rising protectionism?
So I think we need to specify here. I mean, China is a huge opportunity for us. Yeah? We have 7,500 employees in China. China is about 15% of our revenue, and I'm super proud of what the team has achieved there. And we are an integral part of the Chinese healthcare system. When it's about de-risking, the first topic is make use of the opportunity in China. The second topic then about de-risking, what is important is that the rest of the business, being able to deliver or being able to live up to the expectations of customers in the rest of the world, outside China, doesn't depend on China. So that's for me the topic, and we have also worked on decoupling, so to say, the supply chain, but we are extremely committed to further investing in China and making use of the opportunity there.
And so decoupling the supply chain, how have you done that? And do you find yourself better insulated to say if you had an issue like the pandemic where these things were to halt? Have you insulated yourself to that?
I mean, first of all, we were extremely resilient during the pandemic. It was, I think, a big, kudos to the team, but also it showed, that we as a global market leader had a lot of scale. We are now able to deliver the demand in China from Chinese locations and factories, and to supply the demand in Europe, the United States, out of Germany and the United States. So it's about basically decoupling the supply chains so that we are not too much dependent on goods flowing from one sphere to the other.
Well, Bernd Montag, the Chief Executive Officer of Siemens Healthineers, thank you so much for joining us today. Anna, I'll send it back to you with that, a conversation about the promise of AI in healthcare, and of course a health check, I should say, on the German economy.
Yeah, absolutely. And finishing the conversation there on China, which is useful to us, Bloomberg's Oliver Crook. Thank you very much. Coming up, I should just say, on today's programming and tomorrow, we'll be live from the Berlin Global Dialogue Forum. The German Chancellor Olaf Scholz will be speaking to Bloomberg's Stephanie Flanders. That's at 2 p.m. UK time. And tomorrow, Bloomberg's Danny Berger will be joined on stage by BlackRock CEO Larry Fink. So two important conversations there. And I say it's useful to end that conversation there with Siemens Healthineers on China, Tom, because we have some Chinese news.
Yeah, so this was a redhead crossing the terminal that China is looking to appoint Lan Fuan as the new finance minister. He's going to be elected, or he is being moved already, to the party chief of the Ministry of Finance, which on a political role from the CCP is the most powerful role that you can have within that ministry, and that is paving the way for him to take over from Liu Kun, who's the current Minister of Finance, has been in the role since 2018. So an update there, and of course on a consequential position as Europe and China engage, or at least look to engage, on questions of finance and on questions of the electric vehicle subsidy probe, of course. And as we know that working groups are being set up between the US and China as well to discuss some broader economics and financial concerns as well. So this role will be central to those conversations. Coming up, a key measure of how bond investors are compensated for holding long-term debt turns positive for the first time since June of 2021. We'll get more on the impact and the context. This is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand. What's really interesting about retail in my 20-plus experience is that convenience never reverts itself.
Back to Bloomberg Daybreak here.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back. This is Bloomberg Markets today. European stocks are pretty flat this morning. Let's talk about what's happening in these markets, though. Behind the scenes, Noor Al-Ali joins us from the Markets Live team. And I say it's flat because stocks are pretty flat, US futures pretty flat. But one thing that is really exciting markets right now is the return of term premium. It's been absent for quite a while. So this is the compensation that you get if you invest at the long end of the Treasury curve rather than the short end. So lend money to the government in the US over a long time horizon. Term premium has returned. A lot of people are obsessing around it. And it's partly explaining some of the steepening we're seeing in the curve. What do you make of it, Noor?
Yeah, absolutely, and it is, right? Because the longer end of the curve is really much more about the increased supply of those longer end maturities, especially by the Treasury. You know, you have higher climate needs, you have higher spending, more fiscal needs as well out of the U.S. So we've seen that. We've talked about it in the summer, and now it's coming back. And you see now investors demanding those higher yields because there's also a lot of uncertainty. It's not just about what's up ahead. There's uncertainty about the economy, there's uncertainty about inflation, and when junk bonds or high yielding bonds are offering much better returns, and you're seeing that volatility in treasuries, investors now are saying, if we're going to come back into the market and start putting in our money, we're going to want better returns for our investments.
Of course, what is happening in yields, what is happening in bonds is tied to what's happening in inflation, and the write-up from our team at BN around the inflation print out of Spain is Spanish inflation quickens, backing higher for longer ECB rates. Is it as simple as that? We had North Rhine-Westphalia, my new favourite state in Germany, coming out with inflation that was slightly softer than expectations. And this is a bit of a headline story when it comes to Spain. What do you make of the inflation data?
Look, I agree, right? I mean, I took a different route here because I looked at core. And I know we can't subtract core because it's all about the consumer now, consumer expectations, and what's happening to the consumer globally, not just in the euro area. But if you look at core, it has come in softer than expected. You are seeing, obviously, we are expecting perhaps a resurgence because it's all tied to that fuel story, that higher oil story. Demand is picking up. That's why we've seen prices come up. Our economists led by Ziad Daoud came out today with a report that said it's all about demand. 2/3 of the increase of oil prices has actually been because of the stronger demand that we've seen for oil. And the last third is actually an increase in supply. So it's a much bigger story there.
Noor Al-Ali from our Markets Live team, thank you very much indeed, walking through some of the key themes. Remember, of course, you can get up-to-date analysis and insight from Noor and the rest of the team. Futures in the US are flat. Here in Europe, you're down by 0.1%. This is Bloomberg.
so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because he's really bothering me.
My knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good.
Distracting me with your fancy hands.
Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. Oil pushing closer to that $100 a barrel mark, driving expectations of those higher for longer interest rates and keeping pressure on global markets. Germany's bellwether state sees a softening in price rises with national numbers expected to follow suit. But on the other hand, Spanish CPI, that's accelerating for a second month, highlighting the difficult job the ECB is facing. Plus, Italy's government sets up a potential confrontation with Brussels, delaying its deadline to meet the EU budget deficit target by at least a year. Let's take a look at the European markets map because, look, there are a lot of different geopolitical cross-currents. The Asian session largely in the red. In the European session, not so much. You are seeing some underperformers in the FTSE 100, down about 0.4% over here on the island. But if you actually do look across the continent, seeing a little bit of green on the screen. But this isn't one I would call that has a lot of momentum. Take a look at the FTSE MIB in Italy, higher by 0.2%. See a same margin as some of its other peers. The DAX, on the other hand, virtually unchanged, which is interesting because we are still getting that Germany Brandenburg CPI numbers right now for the September reading, a 5.6% increase year over year. Again, no major movement yet in the DAX, pretty similar to what we saw in that regional data this morning as well, but certainly one that we're going to keep an eye on very, very closely. Let's talk about the major story in markets, which of course is going to be oil marching towards $100 a barrel. And it really comes down to this dynamic, specifically in the United States. It's going to start pushing prices up on this side of the world as well. It's in WTI. Now we're going to get a little nerdy. Stick with me here. We're showing some backwardation, and that's what this spike here really indicates. It basically means that the contract right now is far more expensive, far more pricey than the second contract. It basically means there's so much demand for right here, right now supply, really an indication of that physical market tightness. And that's why you're seeing such a spike. It means that need for oil right now is getting more and more intense. At the same time, we're talking about what that means for fiscal budgets around the world. Japan, the United States, even right here in Europe. We're talking about Italy, of course. That's going to be a big piece of their equation as they delay their meeting of the EU's fiscal limit requirements. I'm going to get a little bit more analysis on that in just a moment. But for now, what you need to know in terms of the market reaction is that the spread against Germany widening 30 basis points in September alone. That's what this spike is all about. I'll give you one more spike to keep an eye on, and that is going to be the Bloomberg Dollar Index, because that is on a tear. You're continuing to see some real weakness in the pound, in the euro, in the Swiss franc as well, all pushing the dollar higher and higher, not to mention the Japanese yen. But what it's doing in return is some of those European currencies are indeed in oversold territory. So that's going to be something we watch very, very closely. Joining me now for a little bit more economic analysis, Janet Henry, Global Chief Economist over at HSBC. Janet, pleasure to have you on the program. Thank you for joining me this morning. Let's start with the oil question first. $100 on the horizon. How worried should we be?
It's something we really don't need right now, but I think it's just one of the many factors in the mix. When we think about the impact of higher oil prices, yes, we are now at a level where they are higher than they were this time last year. They're still nowhere near the peaks that they hit in 2022. And rise in oil prices impacts differently on different countries. In the past, you would get a rise in oil prices. People were spending more to fill their car with fuel. That cut back what they could spend on other goods and services. The economy slowed down. But the trouble with it happening now is that it's another factor that's likely to keep inflation higher for longer. And when it's already been above target for 3 years, it's much more likely to feed into pay settlements at a time when the labour market's still tight. So, yeah, absolutely still feeding that idea that maybe central banks haven't finished raising rates, and indeed even more likely to keep it higher. You can have a stagflationary environment. The growth can be awful, but inflation's sticky, and they still can't cut rates.
I mean, this was the lesson ultimately from the 1970s, right? That basically you keep going strong on the rates picture, even to avoid a second sort of uptick in the inflation number, specifically driven by commodities. Basically, that would be Powell and Lagarde's worst nightmare. Let's talk a little bit about the bond story, though, because when you talk about the market reaction, oil and bonds not on the same page right now, whereas post-pandemic, they used to be. Talk to us a little bit about bond yields and what they're telling you about the health of the global economy.
Well, it depends which part of bond yields
you pick. Take your pick.
Well, I suppose the market keeps thinking that this is a normal cycle. And that's where we've been now for about 2 years, ever since the Fed first started to raise interest rates. And then when we had the war, it was the US economy is going into recession. You know, the consensus has been forecasting a US recession almost permanently since late 2022. It's only in the last couple of months that the consensus has said maybe we're not going to have a recession. Maybe we are in a different world. And I think we probably are. It may have been an aggressive cycle. It was short, but we are going to stay there for quite an extended period. This is another factor that's going to do that. And central banks, our next stage will be, even once they've peaked, if they have already peaked, is what at the pace that they're going to fall. Are they going back to zero? I don't think they are. Any easing cycle is still likely to be a lot smaller. We're not going back to a zero rate world.
Well, it's not a secret here that we are in this kind of late cycle phase for the global economy, but it's almost interesting that we've been in this late cycle phase, I want to say for 2 or 3 years now. It's a really long late cycle. Talk to us about just how much longer that could be.
Well, it is something of a long, slow grind. You know, for the last 18 months, nearly 2 years, I've been talking about the idea of a rolling recession, a partial recession. We know that there are signs of strain in every economy. In Europe, you're seeing rising bankruptcies in certain sectors. In the US, you are seeing certain income groups and households where credit card loans and auto loans, you're seeing delinquencies. You've got some countries in the world where they're tied to short-term interest rates. Consumer spending is falling sharply because they're spending so much. So it is a multi-year adjustment. So it's an extended period of very weak growth. We still have below potential growth rates, even in our 2025 forecasts.
I mean, a scary prospect to say, look, we've come so much from the pandemic, and even the lasting effects of that could be even more lasting than we thought. Look, we're talking a lot about the narrative around the world right now. It seems very binary. Recession, no recession. Inflation, no inflation. But then you have countries like China or even Sweden that are talking about a major property crisis. And I feel like when those headlines first came, there was a lot more reaction to it, a lot more sensitivity. Your take on the role of Evergrande, of China, what is the read-through into the global economy? Should we care?
Well, first, on the first point, you're absolutely right. It's recession, no recession, as though at least we've got a recession, we can expect rate cuts quite quickly.
Yeah.
The fact is, it's going to be different. It is a different world that we are in. But on the property market story, and particularly in terms of the China story, we know for a lot of the last couple of decades, the property sector, it makes up such a big share of the Chinese economy, it drove a lot of the growth. We've obviously seen over the course of the last couple of months some more aggressive measures coming through on the housing market, but nothing like the kind of China broad-based policy stimulus that we saw in 2009 or 2016, which really floated all boats in the global economy. It will be, a bit like the Fed, watching the data. Does it show signs of stabilizing? We know there need to be restructurings. We know there need to be asset sales. Does the economy need more to stabilize the property market in this multi-year adjustment and to deal with the local government indebtedness in certain areas? But other signs of the economy are showing some stabilization. But China at the moment is not going to be the lift to the global economy that it has during periods of previous global slowdowns.
I mean, the easiest roadmap to your point to find that out is in the last global financial crisis, wasn't China's major infrastructure plan what ultimately helped the global economy to some extent? I think it was in, I want to say 2009, if I'm right. The sensitivity to China, has it increased or decreased since then?
It depends on the economy and which part of the economy.
All right, let's talk about the U.S.
The US, well, I think, in 2009, it lifted everyone. I mean, the U.S. is a much less export-dependent economy. But in 2009, if infrastructure is booming, if property is booming, then all commodity producers benefit, all capital goods producers benefit in terms of their export growth. The new period that we are now in China, which is lower growth but also a different mix of growth, infrastructure's been doing okay, industrial production's been doing okay, but they may not accelerate very much. The kind of growth that China wants over the next 3 to 5 years is going to be much more service sector driven, much more high-tech driven. We keep hearing this story about electric vehicles and China being the world's largest car exporter.
Yeah.
The sensitivity to the world, the lift to the world, even if China does surprise from this higher quality growth story, it won't provide the same lift to the global economy than those previous periods did.
Yeah. You need the right concoction of growth.
You need to be exposed to the domestic economy if China
Right.
does surprise on the growth side.
Certainly something I'm sure Europe will capitalize on if we start to see that growth actually come to be. Jana Henry, Global Chief Economist over HSBC, thank you for joining me this morning. And of course, a reminder for you that the Berlin Global Dialogue Forum is underway. You can continue watching it on Live Go on your Bloomberg terminal, just LIVE Go. Stephanie Flanders right now hosting a panel with European Council President Charles Michel and Merrill Lynch International CEO Bernie Mensa. Plus, German Chancellor Olaf Scholz will be speaking to Bloomberg's Stephanie Flanders as well today at about 2 p.m. UK time. And tomorrow, Bloomberg's Danny Berger will be joined on stage by BlackRock CEO Larry Fink. 2 conversations you do not want to miss. Coming up on this program, Italy risks a budget battle with Brussels after delaying its deadline to meet the EU's deficit limit by a year. We'll get you the details next. Stick with us. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, Italy has delayed meeting the EU's budget rules by a year, risking a confrontation with Brussels. Italy is not the only country struggling to meet EU fiscal rules, but the plan does underscore the challenge Prime Minister Giorgia Meloni faces in balancing tax cut promises and souring economic growth. Joining us now for more is Bloomberg's Alessandra Migliaccio, joining us from Rome. Alessandra, pleasure to have you on the show. Let's start off with the budget itself. A fairly cautious budget. People were expecting the worst. Where did we land on that spectrum?
That's right. The budget is a very cautious, considering we were very, very much worried that there was going to be crazy spending because this is a political government, it's a far-right government, and they promised a lot to voters. But actually, I think they realized they need to keep it under control, but they can't do everything. So Finance Minister Giorgetti told us last night at a press conference, Brussels will just have to understand. And what they have to understand is that Italy will not be able to go under that infamous 3% limit for deficit until at least 2026. Previously, they had said they would do it by 2025. So when that limit comes back into being next year, that is going to be a problem. That's going to be something that Brussels is going to look at. Why is this happening? Well, of course, some of those promises they will have to keep. It is a political government, so tax cuts, help to families with struggling with inflation, and then there's growth that is just not what it used to be. Germany's struggling, much of Europe is struggling, and Italy is feeling it as well.
I mean, it feels like the markets are also feeling it. If you look at the spread between Italian BTPs and German bunds already widening quite a bit just this morning alone, how concerned should investors be?
There's reason to be worried. It's not immediate. I mean, again, we were expecting worse. The government has actually been reasonable to a certain extent in what it's doing. But Italy has mammoth debt. We've known this for a long time. And the fact that they're going to have trouble, getting that deficit under control, and they're going to have trouble with the overall debt number, which is around 140% of GDP, it is concerning, for the future, because if anything happens to make the situation worse, and we know in this very uncertain world, all kinds of things have been happening of late, that could really be a problem. Italy could have trouble servicing its debt, and obviously that is something the market is looking at.
Bloomberg's Alessandra Migliaccio giving us that crucial update this morning. Thank you for joining the program. Now, coming up, the right kind of wrong, I guess. We speak to the author of a new book on why learning to fail can actually teach us to thrive. It's an interview you don't want to miss. Stick with us. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Some major pre-market action in the U.S. happening right now. Micron in the news, of course. We know in the overnight session after hours of the U.S. close, Micron Technology did report earnings that came out pretty disappointing. And you're seeing some of those losses really accelerate in the pre-market. It was down about 4% after hours. Yesterday is now down about 5.5% today. Really at its core, predicting a steeper loss than expected. We know there has been a major glut in the memory chip market, and supply concerns switched into demand concerns, something you're seeing with some of its international peers like Samsung and SK Hynix as well. So as we monitor that stock, we will bring you the news there, but not looking great right now for the chips story. I think this is an easy transition to make. Look, failure in the stock, failure in life, I guess. Is there a right way to do that? Well, a new book by my next guest teaches us how to, quote, fail well and how it's an important route to success in life. I'm joined right here on set by Amy Edmondson, Harvard Business School professor of leadership and management and author of Right Kind of Wrong, Why Learning to Fail Can Teach Us to Thrive. And I've even got a little prop here so we can show our audience that you have your name on an actual trade book. It's very exciting. I'd like my name on a book. Look, when we talk about the major CEOs of the world, the ones that we cover the helm of, Microsoft, Meta, et cetera, there are so many of them who say, look, I dropped out of Harvard. I messed up my very first couple of projects. LeBron James, I never made the JV basketball team. I mean, things like that. It feels like to be successful, you almost have to fail. Is that how you characterize it?
Absolutely spot on. In fact, I would argue the most successful people in any endeavor, whether it's sports or science, are those who have very likely failed more than the rest of us.
I mean, what do you assign that to, though? Is it just a question of grit, then?
It's grit, but it's also a willingness to stretch. Right? It's a willingness to take on challenges in which you might not succeed. Right? If you only take safe bets, you're much less likely to fail, but you're also much less likely to achieve.
Well, okay, so some would argue that taking safe bets actually maybe makes you a little bit happier, makes you a little bit more comfortable. Is that a fair way to say maybe failure isn't all that good?
It is a fair way to put it, but I am not sure that happiness is the goal or comfort. In fact, I'm quite sure that comfort isn't the goal. I think we have to get comfortable being uncomfortable if we want to make real contributions and achieve and ultimately get the joy and satisfaction of accomplishing things that were hard.
How does time apply here? And I'm really personally asking this for my own sake, as you know, and as our audience will know, I moved to London about a month ago, and I'm very uncomfortable, as anyone would be, when they're moving countries. What is the appropriate time for that to last?
It completely depends on the task, right? So if you're a scientist trying to come up with a new therapeutic that cures some rare disease, you're going to have to be patient for a decade, right? Because that's about how long it takes to go from bench to bedside. If you're a new Londoner, I think maybe a few months, you'll be good to go.
I mean, I'm gonna hold you to that, because the minute the clock turns, I'm gonna call you and say, look, I'm still struggling. I mean, argue against your own argument if you can. What are the exceptions to the rule there?
Absolutely. So, I mean, people ask me this all the time. Well, where is it not okay to fail? And I am absolutely committed to preventing preventable failures in contexts where the stakes are too high. Right? So the first thing you need to do is say, what's really at stake here? From a safety perspective, economically, and reputationally. And if those stakes are high, then you do everything you can to follow best practices, not take excessive risks, and make sure to succeed at what you're trying to do. But when you're trying to discover new things, achieve a goal that has not yet been achieved, then you're in new territory. And when you're in new territory, you have no choice but to fail. So you're trying to, you have good reason to believe it might work, right? You don't go out in a foolhardy way saying, let's just fail today. You say, I think this might work, but you're well aware that it also might not. So the intelligent failure is the kind that takes place in new territory in pursuit of a goal with a good reason to believe it might work, and it's as small as possible, just big enough to get the learning that you need to advance further.
Do you have a favorite failure story of your own, or of a celebrity or someone you follow, one that you really kind of keep close to heart?
Oh, that's such a good question. I guess I'll share one of my own, because I was a PhD student with a hypothesis that said simply that better healthcare teams would make fewer errors. And my data, once I finally had it, suggested that the exact opposite was true. I had failed miserably. I had a statistically significant relationship between teamwork and error rates in the wrong direction. Ultimately, the data were actually far more complicated than that, and what I had really discovered was that there were wild differences in terms of people's willingness to speak up about error, which ended up being a far more interesting finding. So that failure led directly to subsequent, at least academic success.
Yeah, I mean, it makes a lot of sense. One of my very first bosses at Bloomberg actually encouraged that. I started on the analysis side, and he would say, look, you need to go out into the public, you need to explain why your thesis, your investment thesis was wrong, if it is indeed wrong. And that ended up creating a lot of confidence in how to view the market. So I completely understand what you're saying there. Amy Edmondson, we have to leave it there, but I mean, a fascinating conversation, because to your point, we see it a little bit of everywhere, from the C-suite all the way down to even newbies just starting out. Thank you so much for joining the program. She is the Harvard Business School's professor and author of Right Kind of Wrong. I have the book right here. You have to check it out, Why Learning to Fail Can Teach Us to Thrive. A quick check before we say goodbye on the markets here. Micron, of course, still selling off. You are still seeing pain there, down about 5.1%, trading about $64 a share. This comes after, of course, the earnings yesterday in the U.S. session, after-hour session, disappointed to a pretty big degree. We will keep you updated on that slide as we get it. Coming up on the show, the UK party conference season is upon us. We dive into the details. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware. And that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rate World Cup.
This is a 3 as the economic picture does.
The BOK is getting ready to make a decision.
Good morning and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, economy, financial services, and markets. I'm Kriti Gupta in London. Now, party conference season is one of the highlights of the UK political calendar. The Prime Minister's party, the Conservatives, will meet in Manchester in just a few days' time. On the other hand, the opposition Labour Party is ahead in the polls by 15 to 20 points. Donations to Labour have been increasing as we head towards an election likely in about 12 months' time. Now, Labour's conference kicks off the following week. Joining me now is Bloomberg's Adrian Wooldridge and Lizzie Burden, who, by the way, will actually be at the conference next week. Adrian, we're going to get to you in a sec, but Lizzie, set the stage for us for what to expect next week.
Well, it's a very different atmosphere to this time last year when we had party conferences and, of course, Liz Truss's administration was in chaos. This year, it's the first time for Rishi Sunak as Prime Minister at conference, and he is setting the scene for the general election. So short of manifestos, this is where we'll find out from both parties the lay of the land as we head towards that general election. For the Conservatives, as you say, they're behind in the polls, not just by double digits, but by 15 to 20 points. For Labour, they've got to show the actual positive case for why you would want to vote for them at this point and show to the conference attendees that they are a government in waiting.
Adrian, Lizzie just set that up beautifully. What's the game changer here for you?
The game changer in what sense?
The game changer as in what could really throw you for a loop next week?
If the Tories did so well that they leapt ahead in the polls. I mean, I think you ask about game changers, but the reason why I'm having difficulty answering that question is it looks pretty set in stone what's happening. The Tories have been behind by 15 to 20 points for a long, long time now. So it's hard to see anything really shaking this up. And Keir Starmer's challenge is to not do anything wrong, and Rishi Sunak's challenge is to do something so extraordinary that people are forced to look again at the two parties. Both of those, I mean, that's a very hard thing to do.
I mean, let's dive in specifically to the Rishi Sunak piece of the equation, because Justin, I think the last 7 days or so, he's turned around on that green policy. I imagine that's already going to get quite a bit of pushback, not just from his colleagues, but those across the aisle as well. How much pushback?
Oh, a lot of pushback from his party. The reason he's done it is quite interesting. I think he's always been very nervous about spending a lot of money, spending money that we don't have. That was what really led him to doubt Boris Johnson's prime ministership. He's been worried about HS2 and the exploding costs for a long time. So that's been a long-term thinking in his mind. But the other thing was the the by-election, Boris Johnson's seat, which strangely enough didn't go to Labour. The Conservatives managed to hold on to it essentially because of the ULEZ charges. So he began to think, not only is it wrong to be spending all this money, but we might have some sort of way of using nervousness about the cost of green policies to shake up British politics.
I think you used that key word, the cost of green policies. Yes. And Lizzie, I want to bring you in here because we kind of dove into this last week as well. This idea that, is this actually him being austere and smart, or is this purely political? What is your take?
Well, that's the gamble, isn't it? He's gambling that people care more about the cost of living than they do about climate change. And you can ask whether it's political. The Conservatives say it isn't. And yet, you mentioned, Adrian, about the coincidence of this happening just after that by-election. They also, the Conservatives, right after making this announcement on net zero, started attacking Labour. So you could ask whether this is all part of the Conservative strategy to make the Labour Party defend that centre-left position and stick to the detail and break it down on ideology. That's where the Tories are really going to be trying to drive a wedge as we get closer and closer to the election, making it more difficult for Keir Starmer. It may not change the polls completely, but Sunak's going to be hoping he can bring the parties closer together. You mentioned as well HS2, Adrian. I think the similarity between the two issues of net zero and HS2 is it puts a question mark over this image Sunak's been trying to present of himself as a Prime Minister for the long term, because these are long-term issues, both of them.
Yeah, we'll dive into HS2 in a second, but your initial take on that, do you agree with Lizzie?
Yeah, absolutely. And it is quite interesting that since Sunak has, it's not just the ULEZ issue, I mean, now raising the issue of the cost of green issues has led to the biggest sort of decline in Labour's lead that we've seen for a long time. It is beginning to, I think there's been a sort of 6-point shift. It is beginning to cast doubt about Labour. And so if Labour looks as though it's not the party of not radical change, but of change, that's a good thing. But if it looks as though it's the party sort of in some way defending a soggy status quo that is costing ordinary people a lot of money, then, again, you have a chance of changing people's perceptions.
All right, so let's talk about this HS2 debacle, if we will, putting it lightly. I feel like, how do we fix this? How does Rishi Sunak clean this up?
Well, one of the problems is that the Tory party conference is in Manchester, that great city. And, and you know, if you're going to Manchester and say, you know, here I am and I'm not building a HS2 to Manchester, I've decided to cut it off, you know, in Birmingham, that's not a very good look. I mean, they've been worried for a long time about the costs of HS2 because it has been going up and up and up and up, and it is a huge, huge cost. But on the other hand, you know, stopping building, you know, in the middle, building the bridge halfway and then just leaving it hanging there is not a good look. I mean, it's not a very sensible policy, particularly if you're trying to brand yourself as somebody who's a pragmatic politician with a view to the long-term future of the country, as Sunak is.
Well, we should mention, for our global audience and for our UK audience, we did not mean to laugh at Manchester. We appreciate our Manchester viewership. Lizzie is from Manchester herself, so we want to make sure we don't offend anyone there. But Lizzie, your take then on kind of the trade-off between that long-term vision that Adrian was just talking about and the short-term cost, which again is why I think some people might argue that this actually wasn't a political move at all. It's the idea that, like Italy, like Spain, like France and Germany, and like really every country around the world, the fiscal deficit is a real issue.
Yeah, indeed. I'm glad, Adrian, that you agree with me that Manchester's a great city, not provincial, as your
you would never say that.
In terms of the idea of HS2 and whether to go ahead with it, it brings into question the commitment of the Conservatives to this project of levelling up that was so central to Boris Johnson's agenda, and then whether the Conservatives can hold on to the red wall, those crucial seats in the north. But before Boris Johnson as well, George Osborne had his Northern Powerhouse project too, to which HS2 was central. We were speaking to the CEO of the Northern Powerhouse Partnership on the Bloomberg UK Politics podcast, and interestingly, he said that businesses in the north are now looking at the Conservatives and looking through them, because they just don't expect them to be in power after the next election. So they're making investment decisions on the basis that the next government is going to be red. And that's really worrying, I think, for the Conservatives. And it reflects our MLive Pulse survey, which showed that I think it was 2/3 of finance professionals see Keir Starmer as better for the pound and for the stock market.
Adrian, would you agree with that? Is Keir Starmer the more business-friendly leader?
Absolutely, I agree with that as a perception that business has made two decisions. One is that he's going to be the Prime Minister, so they better be nice to him. And secondly, that the Tory party has been such a disaster over the last 13 years, 14 years almost now, of changing policies of Brexit and all of these things, that, the Labour Party is probably the better, safer bet as a party.
Is that why, when we saw that survey, I think Lizzie was the one who brought this up, that this is actually contrary to the historical norms that we've seen. Business tends to favor the other side of the aisle.
Business tends to be pro-Conservative until it has a long period of the Conservative parties in power. So, you had exactly the same thing with John Major, that business fell out of love with the Conservatives, the natural party of business, because they made such a mess of things. Internally, they were constantly bickering and fighting with each other. So they then turned to Tony Blair. And removing Jeremy Corbyn from the equation was a revolutionary moment. It allowed Labour to recover its position as a party in the centre ground.
Interesting. I really enjoyed your comment about sometimes when you have too much Conservatives, it can be a bit too much. It's like eating too much cakes. At some point, it's a bit too much.
I think parties, when they're in power for too long, they get to infighting a lot, and they forget how awful it is to be in opposition. And so they need a period of opposition to remind them, and then they get back into power and are sensible for a bit until they get drunk with power again.
All right, so Lizzie, Keir Starmer, clearly at the top of his game right now. Where does it go wrong for him?
Well, I think it's easy to say that the Conservatives are looking tired of all this time in government. But then if you contrast Keir Starmer to Tony Blair, and this is one that's being made a lot right now, ask the question, is Keir Starmer the heir to Blair? You have to ask whether it's actually all that novel and whether it's a positive case to vote Labour. I think, Adrian, you said that it's not looking transatlantic, it's looking defensive at the moment, and that's what Keir Starmer is going to have to turn around. He's come a long way from the Jeremy Corbyn era. Of course, you saw that surge in stocks and sterling when Boris Johnson beat Jeremy Corbyn, but there's more to do to make sure that this is really in the bag for Labour.
Adrian, your thoughts?
Well, you see, in 1997, everything looked good for a leftish party, such as New Labour, as it was redubbed. You had a young, vital president in the United States of the same ideological persuasion in Bill Clinton. You had a sort of new progressive sort of set of ideas about the third way and things like that. And you had you had economic room for expansion and innovative policies. You've got none of those things. Even Joe Biden's best friend wouldn't say that he's a young, sprightly, innovative fellow. Biden has a set of policies which are very ambitious. But we don't have the money to do that in this country. So the Labour Party was talking about spending $40 billion a year on a Green New Deal. Then suddenly looked at the finances and said, we can't do that. So they're pulling back on all of that sort of thing. And they're basically coming out with piecemeal policies, some of which they almost immediately walk back, such as removing the charitable status on public schools. So you don't have that sense of dynamism. You don't have room for dynamism, either ideological or practical dynamism for Labour. So it's going to be a very, very nervous, practical party that we get.
Innovation is expensive, as expensive. People, I think,
HS2 has demonstrated.
Yeah, very, very, very clearly. A fantastic panel, fantastic insights. Bloomberg's Lizzie Burden and Adrian Wooldridge from Bloomberg Opinion. Thank you for joining the program with your insights. Coming up on the program, if Labour win the next election, they'll inherit a government with finances in a pretty dire state. I think we've underscored that pretty well here. We'll discuss some of the challenges facing party leader Keir Starmer next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your night because it's really bothering me.
My nights.
Yeah, He's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Economics, finance, politics. This is the Bloomberg UK. I'm Kriti Gupta in London. Now, a recent Bloomberg MLI Pulse survey says a Labour-led government after the next election would be the best result for stocks and the pound. But the Labour opposition leader faces tough economic headwinds in his bid to emulate Tony Blair. That's the topic of our recent Big Take story on Keir Starmer. Joining us for more now is Bloomberg's UK Bureau Chief, Ruth David, joining me right here on set. Ruth, all right, talk to us a little bit about this character that we've profiled, basically. What are the challenges? What are the successes?
One of the things we definitely know about him is, unlike many of the prime ministerial predecessors, he did not go to Oxford for an undergraduate degree.
A scandal.
Yes, he's a Leeds graduate. He's talking about changing the class ceiling, which is an issue that's very personal to him in the UK. And that, I think, illustrates one of the many challenges he's facing. Today, we've got news that his plan to cut tax breaks for private schools, he's had to roll back on that. So you're looking at a leader that is coming into a possible election win that they haven't had since the days of Tony Blair, and was this very charismatic Labour leader. He'd won the elections 3 times over, and he was facing a lot of challenges, but the challenges right now, whether you're talking about a cost of living crisis, high mortgage rates, inflation that's so sticky, the looming threat of what Russia does next and how that affects the UK. The electorate in the UK seems to be wondering, can any party really solve these things? Which is why, even though Labour has had this strong lead over the Conservatives for months now, we're seeing some of that slip in recent weeks, illustrating the fact that the electorate is thinking, well, who can fix these problems? And Keir Starmer makes one promise one day and then seems to have to backtrack on it the next day.
I mean, it's a tough position to be in, not going to lie, for a lot of world leaders on the monetary front and the fiscal front. But I think one of the advantages that the UK really has, and I would argue other European countries as well, is that the use of fiscal power seems to be a little bit more direct in terms of the end consumer. You mentioned the tax breaks, for example, that he then had to roll back. But what other kind of fiscal policies are on his agenda?
Well, he is talking about, so one of the things they're saying is giving the OBR more power, right? Which they're arguing that Liz Truss failed to do, and that's what led to the meltdown last year. You had Rachel Reeves in New York in May saying that her economic policies are very similar to Bidenomics, where you're talking about tax breaks and industrial strategy. But the thing is, how much fiscal headroom do they have to do all these things? And even if they are saying we're going to give the OBR more power, or, we're going to take these big projects of the past government and try and see what we can do with them, like the railway, HS2, which is now this line to nowhere, you have to ask yourself, how much power do they really have to make changes? And if inflation stays this way, and I know we're going to talk about home prices a bit as well, if we're not yet seeing the impact of interest rates on mortgages and all of those, that feeding effect into the economy, how much wiggle room does he have? Can he really restore the UK to its pre-Brexit cool Britannia days that Tony Blair boasted of? It's a hard slog.
It doesn't look like it at the moment, or does it? I mean, but I think one of the most kind of chilling stats I've heard, I want to say during my time at Bloomberg, came out of the IMF and World Bank spring meetings last year, where they were talking about these recession calls around the world. And I think that the takeaway, especially from Christina Georgieva, was the idea that the UK recovery would take far longer than not even G10 economies, but really every economy in the world. They had a timestamp of something like 5 or 6 years. And a lot of that is because of the structural changes in this economy, a lot of which I think are seen in the housing market. So let's talk about that, because of course we did get some data, I believe, this morning about home price cuts. Now, on the surface, that sounds like a good thing, but tell me why it might not be.
Yes, and so one of the interesting things is London and Southeast England, the drop in prices is about double what we're seeing. So it's 5% in London and Southeast, and it's about 2.8% in the rest of England. It is a really hard market if you are a seller looking to sell, because buyers are facing, we're now talking about average interest rates of about 6% on your mortgages, right? There's a separate survey out today that shows that homeowners who have property in probably slightly more prime locations are thinking of selling down and moving to smaller, more suburban areas because they simply cannot afford the mortgages. So for the economy as a whole, this is not good news. And also keep in mind that you have the rental market, which is now soaring. So you have potential buyers stuck in this place where they're spending all their savings just on making the rent.
I mean, it's a fascinating dynamic that, again, you're seeing around the world, but the UK serves as a case study almost in that if houses are too expensive, there's more incentive to rent. When rental prices come down, you start to see the flood back into the housing market when rate cuts, for example, eventually emerge. Does that then fuel a housing bubble down the line? And it's a really hard kind of balance to find, I find, between the rental market and the actual sales market. Nevertheless, Bloomberg's Ruth David, all over that story. We thank you for joining us this morning. Now, in case you don't have enough controversy in the UK, we've got one more for you. The go-ahead for a new oil and gas field off the coast of the UK. We're going to discuss the controversial decision next. Stick with us. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The UK's Rosebank oil field has received the go-ahead despite objections from climate groups and pressure on the government to block the development. Joining us for more is Bloomberg's Laura Hurst all over this story. Laura, when I think UK, I don't think energy security, and yet here we are. What do you make of it?
Well, it's quite a small thing in the grand scheme of things. So even though there's a lot of backlash from environmentalist groups, actually it doesn't really move the needle when it comes to energy security. And when the field does come into production in 3-4 years' time, there's a big chance a lot of that oil is going to get exported anyway.
So, I mean, when you look at some of these oil fields around the world, the tendency is you find one, and then you drill all around, and then you drill all around that. Do we start to see the potential of more of those coming online?
Possibly. It seems a little bit unlikely because the investment climate in the UK isn't great at the moment. Of course, you have the energy profits levy that's scared away a lot of industry players, and they've scaled back projects. And the other thing is where this Rosebank field is, it's in the west of Shetland, which is, it's not quite frontier exploration, but there's less infrastructure there. So it's a little more costly, it's deep water, so it seems unlikely.
So the whole drill, baby, drill mantra doesn't necessarily apply there, does it? But is that why it's so controversial, the idea that's just more expensive?
No, not at all. I think it's the idea that it goes against the UK's net zero 2050 goals. But the thing is, the UK still uses quite a lot of oil and gas, and we import the bulk of it because the North Sea is a mature basin and production has been going down since the last 20 years.
Where do you think, from a kind of international appetite for this, you're on the oil team, do people look at this and say, maybe something to think about down the road when that investment appetite does increase?
I think it's tricky for the UK specifically. We've seen a lot of the oil majors, Shell, BP, Exxon, Chevron, leaving the region because, as I said, it's quite a mature basin and it will be in permanent decline. So I think it really doesn't leave a lot of players to be able to eke out the final barrels that are in the region. So it's tricky. It's a good sign, but we also know that there could be a government change in a year, so who knows where things will move from then.
So incrementally helpful, but perhaps not life-changing or game-changing, if we want to put it that way. Bloomberg's Laura Hurst, thank you for joining the program. And, of course, be sure to subscribe to Bloomberg's In the City podcast that Francine Lacqua hosts alongside David Merritt on Apple Podcasts, Spotify, or wherever it is you get your podcasts. New episodes drop every single Thursday. It's a conversation you definitely don't want to miss there. Up next, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York. They're going to set you up for the U.S. trade ahead. Stick with us. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, you know, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on revitalizing the commercial districts throughout the city. So I've been in the middle of that.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A last-minute deal to avert a U.S. shutdown is looking more unlikely. Kevin McCarthy lacks the leverage to clinch a deal. Meanwhile, Republican candidates attack Donald Trump for skipping the party's primary debate and hit President Biden for the country's economic woes. Oil pumps higher. WTI briefly kisses $95, the highest level in more than a year, pressuring global markets and central banks. Danny, a very good morning. It almost felt as if the barbarians were at the equity gate, and certainly the bond vigilantes are alive and well. Still pressure on equities as oil nips higher. You'll take us through the nuances there. Global equities at the bottom of your screen. You've got Micron at the bottom of your screen, down 4.9%, warning this next quarter is going to be tough for them in the fourth quarter. Oil pumps higher, and again, pressure on central banks will come to bear. Oil markets are the top story this morning. Global equities are down for the 10th straight session. What you have here is a line from Neil Kashkari, which is really quite stupendous by itself. If you're going to hang your hat on this, the government shutdown, the auto strike, could slow the economy. and therefore temper what we need to do. Volatility is artificially repressed, according to Kalanovic over at JPM. Equities are down, SPOOs, NASDAQ, and European stocks. And there's a big concern out there. There's an options trader alive. JP Morgan has a massive fund, $16 billion JP Morgan hedged equity fund. They've got a monster position of put options that somebody has got to take a hold of on Friday. Danny, good morning.
Good morning, Manus. I'm impressed you got around having to say delta hedging. I think we can set aside the Greeks for this morning, so thank you for that. Look, elsewhere, the euro is trading at 105. Sure, it is strengthening today, but we are at the level that a lot of forecasters have for their year-end targets. Are we going to have to do a rethink of just how weak the euro might be getting? We did have some regional German CPI data come in. We'll get the whole country at about 1 p.m. UK time. We had Spain data come in too. All of that did come in less than expected. So it's impressive the euro is rallying this morning, but maybe that's just a bounce back from what we've seen from one of the longest losing streaks for the euro since the 90s. If inflation is starting to come down in the euro area, surely it's more bad news for the euro and an ECB that might be faced with weaker growth and the inability to continue to hike. 10-year yields, Manus, you had mentioned this. We're looking at a high of October 2007. We are now above 4.6%. A move higher of 3 basis points this morning. The turnaround was remarkable, despite Neil Kashkari warning that they might have to stop should there be a government shutdown. As you said, Manus, 15 basis point move from the low to the high yesterday, the most in about a month. A big turnaround showing that the bearish momentum is here. And Manus, this is part of what's causing that bearish momentum. It is Brent crude up 0.1%. It's at $97 a barrel. We had a major U.S. stockpile come in much lower. Man, it does start to feel like the tightness of this market, that $100 a barrel feels like maybe an inevitability at this point.
And that's exactly what ING are saying. This is going to be perhaps a short-lived pressure. I thought we'd go for the squeeze. This is the spread. This is the front spread. In other words, the price of oil today relative to a little bit later in the year. And as you can see, it is squeezing aggressively higher. That gives the Saudis the ability to raise their prices to their Asian customers. Amrita Sen said to us, she thinks that this is to do with the destocking, but this pressure point at the front end of the curve is driving the market higher. We'll discuss this and more with Bob McNally from Rapidin a little bit later on. But let's take this squeeze in oil. It's caused angst in equities. It's a vexation for central banks. To Whaley, Global Chief Investment Strategist at BlackRock. Whaley, good to see you this morning on your European tour. How close are we and how real is $100 oil? And what are the implications in the medium term of, let's say, a range of 95 to 105, as people are saying to me? Good morning.
Good morning, Manus. I'm your Berlin correspondent for the day. Yes, indeed, oil price pushing higher in response to production cut news and supply constraint has been sending markets and pushing up market volatility. And that's actually the broader kind of backdrop of a world shaped by supply that we believe in. Because we're in this new regime right now. So you talked about how some of the inflation across Europe and more recently also in the US coming down and alleviating some of the concern. But I think oil price spiking higher is just the evidence that we're actually in an inflation roller coaster rather than getting out of the woods with inflation fighting. And it's not just the oil price, it's also thinking about what's driving inflation. The pandemic shock unwinding has brought inflation down, but labor constraint is going to push inflation higher.
To that point, just in terms of the higher inflationary regime, that's obviously had an impact on Treasury yields. We're headed for a historic 3 consecutive years of losses. We're in uncharted territory when it comes to that. What will be the impact of this rethink on the bond market?
We're also in a different regime with regards to bond market investing. So the ballast of bonds in portfolios has been more challenged, as we have seen last year, as we have seen this year. But income is finally back in bonds. So far this year, the temptation is to look at what's happening in markets through our equity lens. But equities have been very, very concentrated if you look at the U.S. equity market. So really, we believe we should be looking at market dynamics through a rate repricing lens. And so far this year, 10s has moved up by 75 basis points. A large part of that was started early on in the year through cash path repricing. So markets kind of waking up to central banks are going to have to stay higher for longer in this world shaped by supply. But more recently, we also had term premia coming back. Term premia has been deeply negative for a very long time. But in the context of higher bond volatility, in the context of QE giving way to QT, in the context of fiscal imbalance and greater issuance, term premia has more to go, and which is why we have been underweight U.S. long duration for a while, and we continue to be underweight. Now, some opportunities are emerging
Weili, just hold your thoughts on those bigger opportunities, and we're going to reset to those. Yes. I like the fact that you put the context around it. We're on this roller coaster, and we're not out of the woods in terms of inflation. Hold that thought on the roller coaster. We've got three other major stories that we are tracking today on Bloomberg Brief. We've got a late deal to avert a U.S. government shutdown is beginning this weekend. Isn't likely. That's the thinking at the moment. The House Speaker, Kevin McCarthy, making big demands and bringing very little leverage, Danny, to the table at the moment.
Yeah, it's certainly worrying with just, a couple of days to go until that shutdown. The other big story we're tracking, Manus, is Evergrande and its units suspended trading in Hong Kong. That's a day after people familiar with the matter said that the property giant's founder had been taken away by police, Manus.
Well, of course, then we've just had this inflation data from Spain accelerating for a second month, demonstrating the persistence of inflation, the pressure for the ECB to live in this higher for longer regime in their interest rate outlook. Seeking to stamp it out is the challenge. Spain's figures kick off a spate of inflation data across Europe, with the early regional data from Germany pointing to a steep national slowdown. Weili is with us. You've already made it very, very clear that we are on this roller coaster for inflation. So set the table for us in Europe. I know that you've got a preference for being longer of UK and longer of European bonds relative to the US at this moment in time. But how much of that is predicated on rates remaining at this 4% level in Europe? Weili.
We do have the view that rates will remain higher for longer across developed markets, central banks, and this is really the result of us being in this new regime where central banks are likely going to have a tightening bias as opposed to easing bias during the great moderation in response to supply constraint coming from labor market, in response to supply constraint coming from geopolitical fragmentation, as well as the net zero transition. So we do think that term premium has more to come back in the case of the U.S. Government bond market. But the picture is slightly different in Europe, where actually after recent market repricing, there are income opportunities emerging and also kind of mispricing versus our expectation for where the cash path would be for the ECB as well as the BOE, in that if you look at market pricing, we're just looking at 4 cuts in total, in perpetuity by the ECB, which we think is a bit conservative, is a bit extreme. So even though we have the assessment of rates higher for longer, central banks holding tight, our investment view is predicated on what's in the price, and we're starting to see opportunities emerging in international developed markets duration, which is Europe and the UK, but not quite in the US yet, because we think that there is greater room for term premium to come back in that is starting now.
Well, you're talking about some of the mispricing in assets, and we talk about this very frequently. I want to turn this on its head. What do you think makes sense in this market right now? We talk about bubbles in tech, bonds not pricing on the right thing. What do you think is fairly priced in this market right now? What asset is logical to you?
Well, I talked about fixed income investing being in this new regime where finally income is backed. You're talking about 5.2% sitting on the front end of the U.S. Treasury market without taking duration risk, without taking credit risk. That's very, very attractive, especially at this juncture, given nervousness in markets. So we continue to favor the front end of the U.S. Treasury market. One thing I would say, though, is in light of recent, actually, also equity market nervousness in response to rates pushing higher. We have been less positive on equities, but with adjustments coming through, I think opportunities we're getting closer to opportunities down the line. And then Japanese equities has been a bright spot in the context of still very easy monetary policy environment and very shareholder-friendly policies, and also some of the incentives being put in place for domestic investors to get into the equity market, and all of that are teeing up for Japanese equities to be the bright spot at this current juncture, even though the broader sentiment is really feeling the weight of rate repricing, which is just starting.
Okay, well, there's pressure in that Japanese government bond market this morning, so we'll return to that in just a moment, and you whetted our appetite on a little bit more term premium. Whaley, we'll see where the value lies from BlackRock Investment Institute. Our guest this morning, our Berlin reporter personified. Oliver Krug will have a job of competition. Now, the Republican candidates assail President Biden's handling of the UAW strike. Auto workers, they're threatening to expand their strike on Friday. We'll have more of that. And last night's frisky debate. Oil marches higher, closer to $100 a barrel. We discussed that with Bob McNally, president of Rapid Energy Group, a little bit later this hour, right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I side with the auto workers of America and with those who want to make America great again, and I always will.
That was the former U.S. President Donald Trump speaking in Michigan yesterday. He skipped last night's Republican debate to woo the blue-collar voters in that battleground state. Bloomberg's Oliver Krug is tracking the trails this morning. What was the top line of Trump's message? Good morning to the auto workers.
That's right, Manus. He was speaking at Drake Enterprises, actually a non-union parts shop over in Michigan. Really, his message was about economic nationalism, favoring American labor over foreign labor, and really taking a very negative approach and vision of China, and also a negative approach of Biden and EV mandates that he calls are selling out to environmental extremists. This has obviously not been very convincing to union leadership, a fact that Trump is very aware of. In the speech, he said, "Get your union leaders to endorse me, and I'll take care of the rest." And there's an irony here. He spoke in Clinton, Michigan, a state that obviously Hillary Clinton lost and was accused of neglecting during the election. Biden won it, but only by about 150,000 votes, and that was in part because he got 62% of union households.
Yeah, such a crucial measure for the Rust Belt. Oliver, what is the latest on negotiations?
Well, we have another countdown clock, Danny, so set your watch or whatever you use, 10 a.m. Eastern time. Sean Fain will go back to the airwaves, Facebook Live, to give another ultimatum for the big three. If there is no progress made, he will expand the strike even further. And where are we on the actual negotiations? 20% is what's been offered, 40% is what's been asked for. What has changed since last week? Well, for one thing, Biden went out and sort of tacitly backed that the workers should negotiate 40%. Now we understand that the negotiations are around pensions, bringing those back, which were scrapped in 2008 after the restructure. And also now, Ford saying that they're going to scrap their battery plant for the time being. That is going on hold. The union is seeing that as a bargaining tool. Will that mean that Ford is not spared?
Well, you're certainly not spared. I just want to get a sense, Oliver. This is the first time. Wei Li, great to see you in Berlin, but this is the first time Oliver's actually got to share space with anybody. So, do you feel the heat, Ollie? You got a bit of competition?
Well, I mean, it sounds like there's a job opening over at BlackRock, so maybe that's where I should send my CV.
Oh, you could just see him walking up to the front of the podium tomorrow to Larry Fink with Danny going, "Excuse me, Danny. Larry, how are you? I'm Ollie."
I'm sure he'll take to that well. I'm sure he will.
Oliver, we'll see you a little bit later on. Wei Li stays with Danny and I to discuss the government shutdown on a slightly more sobering note. You talk about mega trends and mega threats. Here we are. We're in the midst of a workers' strike in the United States of America, a shutdown that could affect 22 million people in the United States at nearly $2 billion a day. My question to you is this. You talk about mega trends and shifts, regime shifts. Are we entering a regime shift in remuneration globally? Are these idiosyncratic US and European moments?
Well, I was in Vienna yesterday where there is wage negotiation ongoing as well. So this is definitely not just a idiosyncratic, isolated kind of event in Europe, in the US and parts of Europe. It feels like as we think about kind of the broader constraint of labor shortage, the power is incrementally shifting towards the labor, towards the consumers, which are getting a bigger share of a shrinking pie, right? So these are the structural regime change that we are talking about. And as we think about the implication on inflation, it could push inflation higher, which is that roller coaster framing that we talked about.
Well, wait, to marry together two megatrends, not just that one, but the fragmentation, the geopolitical fragmentation also means we're doing this project of friendshoring, onshoring, that sort of thing. Will the project of onshoring work? And if it does, how costly will it be if all of a sudden labor in a lot of the Western domestic markets are much more expensive?
Yeah, friendshoring, reshoring are happening. They are happening slowly but surely in response to geopolitical fragmentation and likely representing a drag on growth and again, gently pushing inflation higher. Would it work? I think in the context of labor shortage, we have to kind of really think about resourcing allocation, and this is where some of the technological innovation advancement can potentially come to the rescue, which is another mega force that we talked about. But just taking a step back, we're really at this moment where cyclical forces are playing out, but really interacting in an incredible way with the mega forces, which is why we really need to consider them in conjunction with each other as we think about even tactical asset allocation, not to mention strategic asset allocation.
You hinted earlier Japan as being one of the sort of more favorable areas. I look at the Japanese government bond market this morning. You're looking at yields at the highest since 2014. I mean, there's pressure in the bond market. The finance minister is talking about intervention. There's the JGBs this morning, but you're looking at some pretty punchy moves in this bond market. What is the biggest tail risk in Japan for us?
Well, I think global markets, global bond markets are very, very correlated. Something happens in the US, it gets fed through overnight to APAC. If it gets fed through, then overnight to Europe. And I think what we're seeing in Japan is also some of that global correlation playing out. The biggest risk is if YCC exit is faster, more sudden than expected. You know, it is a matter of time, not if, but a gradual exit from yield curve control, together with the still very, very shareholder-friendly policy, are likely going to still position Japanese in a better light relatively versus the other parts of the market. But just tie back to mega forces again. We're talking about, you know, not super rosy macro backdrop, stagnating macro backdrop. So really focusing on mega trends, mega forces as we think about what could potentially bring that additional return to your portfolio is key, which is what we're focusing on right now.
Okay, Willie, thank you so much. And you're welcome in the Berlin studio any day of the week with Oliver, Danny, and myself. Willie from BlackRock, a quick snapshot of what's going on with currencies. The dollar breaks trend with 6 sessions in a row of gains. We've just rolled over this morning. SocGen says a prolonged U.S. shutdown would bring peak dollar closer. Yen strengthens ever so slightly as the finance minister steps out and says they're ready to take appropriate action. A small bid to yen. Good morning from New York.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
here is a story that caught my eye, and we'll catch yours because we're looking live at the DC Panda Cam at the zoo, because all the pandas in the American zoos are going away, maybe for good. Zoos in DC, Atlanta, San Diego, and Memphis either turned over their Chinese pandas or will hand them over by the end of the next year as the 3-year agreement from China's wildlife agency comes to an end. Man, as China has long used this panda diplomacy, and we know U.S.-China ties are at a historic low. And this, for me, is heartbreaking. I grew up seeing this exact panda. Oh my God, he's waking up. This is so cute. We could do this for an hour. I'd be okay this being the whole show, Manus.
I don't think I can really add any words to the panda movement at Washington Zoo, apart from, you know, Danny, this goes back to Nixon's era when he normalized relations with China in 1972. So is it a real political readout? The pandas are going. Good night, panda.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Brief. I'm Manus Granny in New York.
And I'm Danny Berger in London. Here's what you need to know. A last-minute deal to avert a U.S. shutdown is looking more unlikely as Kevin McCarthy lacks the leverage to clinch a deal. Meanwhile, Republican candidates attacked Donald Trump for skipping the party's primary debate and hit President Biden for the country's economic woes. And oil pumps higher. WTI briefly hits $95 a barrel, the highest level in more than a year, pressuring global markets and central banks. Let me show you those global markets. The euro with remarkable strength this morning, given that we've seen CPI figures for regional Germany and for Spain come in weaker than expected. We're up about 0.2%. We're still at 105.27 on the euro versus the dollar. This is a level that many folks had for their year-end forecast. Are we about to see en masse revisioning? U.S. 10-year yield, that continues to march higher. We're up by 3 basis points. 4.6% is where we're at, the highest since 2007. We're on track for a historic 3 consecutive years of losses in this bond market. And finally, Brent crude finally seeing just a touch of relief. I mean, barely, though. Brent crude, $96 a barrel, weaker by 0.2%. And Manus, we were just talking to BlackRock's Wei Li about this, hearing something that we often hear, that this will keep the higher for longer narrative on track, with Brent crude marching its way to $100 a barrel.
Yeah, she said very clearly we are on a roller coaster in regards to the inflation narrative. I said to you 30 minutes ago, it felt like the barbarians were at the gates of the equity market, more pressure to come, and that is becoming ever more present through the morning. You are just seeing that spike in yields. I mean, it was pretty vicious yesterday. And again, the equity market is struggling here. Global equities are down for the 10th straight session. Bottom of your screen, down 0.2%. Again, that eruption in yields yesterday really unseated the overall nerves of the market. And oil is the very sort of, it's almost like the pumping muscle of angst in terms of what happens to gas prices here in the States. Stocks are lower this morning by 1/8 of 1%. Micron at the bottom of your screen warned it's going to be tougher going into this final quarter of the year. And for them, they look as if they're trading lower this morning. Decisive actions will be taken on cost. Micron at the moment is down. Let's have a quick look at the price of that at the bottom of your screen. NASDAQ, again, struggling with this higher for longer narrative. Actually, Micron comes back up by 0.4%. Kalanovic over at JP Morgan says this low volatility regime that you've enjoyed will not last. And of course, we also have a monster position in options by one of the big JP Morgan funds out there, the JP Morgan Hedged Equity Fund. It's a $16 billion fund. They've got a monster position in puts, which of course they bought, somebody or a number of people wrote, and they potentially have to take delivery of stock and go, no, we're not having this. So at the moment, Danny, those are the pressures.
Yeah, they are the pressures. I'm also just looking at this Marko Kalanovic note that you mentioned, Manus, of JP Morgan, also saying that markets today rhyme with the 2008 crisis. Now, he's been bearish on this market for some time, but certainly not comforting, saying the core risk for markets in the economy is tied to the interest rate shock of the past 18 months.
Yeah, and here we are. We're beginning to understand about new regimes. BlackRock have just talked about a new regime. We've had various guests this week talk about the regime change that we're going to. Jamie Dimon, not just flying kites, but saying the market is not ready and has not countenanced the possibility of 6 and 7%. But let's circle back to the oil story, Danny, because it did kiss that $95 a barrel yesterday. We've got dwindling stockpiles at a key storage hub, fanning the fears that falling crude supplies globally is going to put more pressure on this market. Bob McNally is president of Rapid Energy Group. It's his first outing on Bloomberg Brief. Normally he's in the overnights with me in the Middle East. Bob, here we are. We've got a very, very damned tight market. The spreads are exploding. The front spreads are exploding higher. First of all, define how tight the market is right now.
Good morning, Manus. So the oil market is getting squeezed and getting squeezed hard, but there's more tightness to come. You know, we're all watching the Cushing inventory depot, right, where WTI is priced. That is heading towards, you know, record low levels, minimum operating levels, really. Now, that'll ease up a little bit, Manus. The refiners are going to turnarounds, et cetera. So maybe we stop nosediving in Cushing. Elsewhere, oil on the water, other places for crude, you know, it's been falling. Stocks have been falling sharply worldwide, but they're not yet at critical levels. Where the real problem is, Manus, going into winter when we burn heating oil, diesel, middle distillate, their stocks are quite low. Europe, Asia, the East Coast. So if I'm an economic planner or a politician, as the winter starts to fall here, I'm worried about those diesel stockpiles and diesel demand especially. But the market is clearly tightening, and traders needed to see it to believe it, and they're seeing it and they're pricing it. But we're not done with this tightening move.
Can you put the numbers to the winter, Bob? Exactly how expensive, what exactly will that result in to see that demand for energy come this winter?
Well, so everything depends really on what Saudi Arabia does. Crude oil is the main driver here. At Rapidan, we've been expecting $95, $96 fourth quarter average Brent prices, meaning, to use Manas's word, daily prices kiss 100 or blow through 100. That's going to put, distillate cracks, the difference between distillate fuel oil and crude oil has been about $50 a barrel. So, we're not going to go back to last year's levels. But here's the deal, as you were talking about, the economy is so fragile. This isn't 2013 or 2012 when the world's growing at 6%. Doesn't really matter. We could go to $120, $130 oil. It doesn't matter. This is a much more fragile, hoped for soft landing kind of economy. So even if we punch up to the high $100 level, $200 level for distillate now per barrel, not crude oil, $100, $105 a barrel, that's the last thing the Federal Reserve and the central banks needed as they were trying to bring the global economy in for a soft landing. But I think we could see easily in the United States $4 gasoline, and distillate, of course, is quite higher.
So I want to take you back to your time when you were with President George W. Bush. We draw on this from time to time. If oil doesn't just kiss, but has a full-on affair and goes over $100, what does that do at the White House? What does that do for Amish Hochstein? What does that do for Biden? Do they have to step in and use the SPR again, which is already, I would say to you, at a dangerous level? Or you can qualify that for me. First of all, SPR draw, is that what happens when we go over $104 at the pump?
I think that's the first resort, probably, but not a big release like 180 million barrels last year. No, they'll probably repeat November of 2021, where they put 30 million barrels or something like that on the table, and then call around to friends and family and the Chinese and see if we can get some contributions there. I don't think they are worried about that 40-year low in SPR. I don't think they'll do another 180 million, but that's it. After that, badgering OPEC and Saudi Arabia in public doesn't work. They're not going to do that. Plus, there's this big diplomatic deal. Here's the real risk, Manis. As we're seeing in Russia this week, critically, there will be pressure to consider limiting the export of refined product and crude. If oil prices melt up, keep on melting up, they know it's a dumb idea, but the political folks may say you got to reach for whatever tool you have. And going and saying, the United States has got to keep more distillate and gasoline here. It would be a disaster, be counterproductive, but that was on the table last year and will come on the table again if we roof above $100.
Bob, what you talked about a soft landing and the impact that would have on oil. What type of landing, what type of recession would actually be able to bring oil prices back down?
I think we would, on the recession side, we'd need a pretty big one, right? The most important factor for bringing oil prices down is going to be whether Saudi Arabia decides to ease up on the unilateral cut. You don't want to do it with a recession. I think you'd really have to take 1 million, 1.5 million barrels a day out of global demand, right now to kind of ease up. But I think then the risk is that the OPEC Plus just cuts even more under that. The real sensible way to bring prices to a sort of heel here is for Saudi Arabia and then OPEC Plus to say, okay, we've made our point. We've scared away the speculative shorts. We've proven that we're not going to let things get out of hand to the downside. We have a bottom in. We can start to feed back oil into the market. So I think that's the sensible way to do it. You don't want to do it with a recession because, again, with these interest rate hikes, things would get out of hand to the downside. It's a very delicate balancing act.
So tell me this, Bob. I mean, you've been in Vienna, you've been in the presence of His Royal Highness, etc. He took the heat out of this back quarter by going for extension of the unilateral cut of 1 million barrels a day. What is the real risk that they will step back from that? Because essentially, that's their way of creating the floor in this market. What is it that could force them to do that? In Calgary last week, he said, we're not going back to the 1980s. Do you think that they are sufficiently, as he likes to see himself, the central banker of oil for the world, are they politically enough aware to know how injurious 105, 110 would be?
Yeah, I think, Manis, the odds are higher than the market is currently discounting that the Saudis will take their foot off the brake sooner, right? They do not want to deliberately over-tighten the market because if you get a spike, then you get the demand collapse and you get a bust. They don't want that. So I think as we look at October, in a few weeks, they'll make a decision. In November, they'll decide about liftings. And they slipped some hints in there. In the announcement on the extension, the Saudis said, look, we're going to still review things every month. And they said we could increase production, whereas in the past, they had only said, we will cut or extend these cuts. So I think that he's dropping lines in the water. He's dropping signals that we're maybe getting close to the point where his point has been made. Risks have been mitigated to the downside, and he can start to play that central banker role and ease up. We're not there yet, but we're getting closer.
Yeah, and if the speculators chased out, maybe. Bob, really great to get your thoughts this morning. We appreciate your time. Bob McNally of Rapid Energy Group. Now, coming up, we're just 3 days away from a U.S. government shutdown, and a deal to avert it seems less and less likely. We're going to have more on that for you next on Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Donald Trump hides behind the walls of his golf clubs and won't show up here to answer questions like all the rest of us are up here to answer. He put $7 trillion on the debt. He should be in this room to answer those questions for the people you talk about who are suffering.
Bidenomics has failed. Wages are not keeping up with inflation. Auto workers and all American workers are feeling it. Families are struggling in this economy. And Joe Biden's Green New Deal agenda is good for Beijing and bad for Detroit.
Chris Christie and Mike Pence there among Republican contenders debating yesterday. 7 of the Republican contenders for the presidential nomination spent 2 hours hammering each other, President Joe Biden and the absent frontrunner, in a debate last night, who later, former President Trump, that is, just said, quote, they are all job candidates. Let's get now to Kate Ackley of Bloomberg Government. Kate, can I just start here on Trump's comment? They're all job candidates. Does anyone see a VP in the group? I don't know. They don't have a crowd like we have. Does it seem like they're just applying for the VP job, looking at this debate, or something else going on?
Well, I think it shows how dismissive Trump is. And, if you look at his lead in the polls, it does make some sense. He's the clear front runner. All of them combined, I think, don't have the same level of support among Republican primary voters as the former president does. So he wasn't on the debate stage yet again, but he also, again, got, big headlines. I mean, there are stories this morning about his rally in Michigan where he put the focus on the striking auto workers and, again, was very dismissive of his fellow rivals, sort of. He's almost taken a general election approach where they, in the debate, those 7 candidates, some of them got into, really divisive issues that were focused on Republican primary voters that would then be harder to run in the general election. Yeah. Whereas you see Trump, he's attacking Biden, and he's kind of running a general election campaign already.
It's interesting, in one of the stories that we wrote overnight, Frank Luntz, a longtime Republican pollster, said the winner tonight was Donald Trump by not participating, and he described it as chaos on the stage. But part of the discussion on that stage was around the UAW strike, where Trump was present and talking to that agenda item, which is so hot button. It's on every news belt every day. How did the hopefuls or the pretenders, as it were, because they certainly don't have the percentage of the faithful behind them, how did they talk about the strike? What did they say they would do?
Well, I think for Republicans, the way that they have been talking about the strike is very interesting because, if you look back decades ago, the Republican Party was very much pro-corporations, anti-unions, but we're seeing different messaging this time around, and it speaks to maybe the changes in the demographics of the Republican Party. So we saw, Senator Tim Scott of South Carolina, he's been critical of these striking union workers. But even he was, working to try to say, well, the problem here is the Biden administration's agenda and, trying to move prematurely to electric vehicles, which will disrupt the U.S. auto industry. So trying to put the blame there. And we saw others on the debate stage as well you saw just in the clip that you showed, former Vice President Mike Pence saying, this is about inflation and blaming Biden and Democrats for inflation, blaming Biden and Democrats for this shift to EVs. So trying to, sort of fracture the labor movement, certainly the auto workers, so that they would support a Republican presidential candidate.
Well, Kate, the other big headline grabber in D.C. is this 3 days away from a government shutdown. Just focusing on the Republicans for a moment. For those who have many federal workers in their districts, how are they handling or not handling this?
Yeah, we took a look this week. We used U.S. Census data. Our team at Bloomberg Government looked at, which lawmakers have the most federal workers in their districts. And no surprise, most have, are Democrats who represent districts in Virginia and Maryland, really close to Washington, D.C. But then there are some other people that you would not expect. Among Republicans, Florida Republican Matt Gaetz, who represents the 1st District down in Florida, which has a lot of military installations. He's up there, so I have to, check my notes, but something like 7-8% of the civilian workers in his district get their paychecks from the federal government. So, there's a dynamic there. If a government shutdown does occur, which looks increasingly likely, these members of Congress are going to be hearing from their constituents who aren't getting a paycheck. And so we are going to be watching that dynamic. It's one thing to talk about cutting government spending and fighting over funding for Ukraine and things like that. But it's another thing when you have a critical mass of constituents in your own congressional district who are not getting their paychecks for some period of time.
Kate, we're going to have to end it there. Thank you so much for waking up early for us. We appreciate it. Kate Ackley of Bloomberg Government. Coming up, Nike reports earnings after the bell. More on that next on Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day and a look at what's ahead. We're going to have German CPI coming in at 8 a.m. Eastern. We're also going to get U.S. data, GDP, core PCE, and jobless claims. All of those hit at 8:30. But will that influence what's coming up down the pipe from a host of Fed speak? We have Chair Powell, Governor Cook, Presidents Goolsbee, and Barkin all on deck. Again, do they need to recalibrate their message from last week? And Nike earnings, that will happen after the U.S. market close. Manus.
Well, let's see what we expect from Nike. The results are due a little bit later today. We're reunited. Simone Foxman, back together. Good to see you.
Good to see you, Manus.
Are you long Nike? Are you a Nike girl, a Lululemon girl? Can you show your bias on this show? But you can tell me about the numbers of Nike.
Well, I personally don't have the bias, but I will say analysts are pretty split here around Nike. I mean, they love the shoes generally, but it's a little unclear where the company is going at this point. There are a handful of different factors at play. I think three really top of mind. Slowing of the American consumer. Are they actually slowing down? That's the same question we've had for a long time. China, how is demand holding up there? China is a decently large part of their market, 14% as of last year. And then also, they're still managing some overruns in terms of inventory. They've had some success at bringing that down. Can they continue to show that success?
Simone, also, as of next week, we're going to have U.S. borrowers having to make student loan repayments for the first time in 3 years. We talk a lot on the show about the potential cracks in the U.S. consumer. Are retailers like Nike talking about this and the potential impact for them?
Yeah, Danny, absolutely they are. I was actually looking through some of the recent earnings calls. We've seen the likes of Kroger's, Academy Sports, Signet Jewelers, Best Buy, Gap, Ulta Beauty. They've all mentioned some concern about the impact of student debt repayments starting to play into their sales. Now, some are a little bit more concerned than others, but essentially the message is no one really knows how this is going to shape up for them. You know, you look at someone like Nike, who's selling $100 plus pairs of shoes. Can they avoid this because their consumer is a little bit better off, has an overall higher income? You know, we've seen some retailers really be able to succeed in the past couple of months, don't seem to feel that impact. And then you hear, you know, Kroger or Costco worrying about how student loan debt repayments are going to impact them. So I think the answer is no one really knows yet. I think we'll certainly be listening for commentary on the call later today, though.
Very briefly, just to wrap up, how important is the dollar on this call and in the numbers, the strength of the dollar?
I mean, the North American business, 40% of their business, right? So that's ultimately the key fundamental bit there. But I think it is important. We're seeing companies start to adjust to these broader foreign currency exchanges. And certainly because the North American bit, the same-store sales are actually supposed to decline a little bit on a year-on-year basis. You know, it could offset some of the strength we're seeing elsewhere.
Let's see how the numbers turn out a little bit later on today. Simone Foxman tracking the retail beat for us here. We're also going to keep an eye on Peloton after a deal with Lululemon. So, I got to say, Lululemon's kit, I have it from years ago here in the US. It lasts, it endures. You're a Peloton kind of girl, aren't you?
Yeah, but I'm going to be honest, Manus. I'm agnostic. I'll buy whatever's on sale. That's all I care about.
Listen, we're going to finish off with bonds. I said it to you at the start. The vigilantes are alive. The barbarians are at the bond gate. The question is, how much more will they shake down the yields? Danny?
Yeah, we are on track for a historic 3 years of losses for this bond market.
Faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
people are clamoring to do is to buy bonds. I think it's too early.
I think you have to be very valuation sensitive in this market.
Buying duration in here, we're about to start swimming downstream again.
I don't think that you're going to re-enter a bear market in equities.
I think there's a lot getting built in that's momentum right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market trying to bounce again, up by 0.1% on the S&P 500. A decent close yesterday, just about in positive territory on the S&P 500. On the NASDAQ, the last 24 hours, some fascinating moves. Crude touching $95 a barrel. TK, your 10-year today, 464.27 is your new cycle high.
If anything, this Thursday is more tumultuous than what we saw Monday, Tuesday, Wednesday. You're right. We had an equity pop at the back end. Maybe it was short cover, whatever. A lot of people talking about that. John Stolfus, the optimist, to be with us here in a bit. But, John, you got to reset and recalibrate on these numbers. There was a moment yesterday. Let me get out the surveillance mouse.
Please do.
And tell you at 12:51 yesterday, we had a 2.30% 10-year real yield. I did not frame that 6 months ago.
The equity market's kind of a snooze. Bond market,
agreed.
Huge moves. Commodity market,
That's a hell of a
95 on
signal,
WTI. FX, 104 briefly on the euro against the dollar. Dollar yen, Lisa, getting closer to 150. Briefly, 149.63 is the high of the session so far.
That's exactly the right observation. Why are stocks so somnolent? Why are they not responding whatsoever to what we're seeing in the rest of markets that seem to be completely roiled? Is there just simply a paralysis, or is this forced selling for funds that don't necessarily have that big of an equity position? I mean, at this point, are we looking at some unraveling that is gaining steam and that nobody wants to get in the way of?
I'm going to go to the Ellen Zentner show, which is what all today is, and particularly at 8:30 when Mike McKee not only gives us GDP blah, blah, blah like he always does, but John, there's a massive multiple set of revisions to our economy. And it is not probable, but possible at 8:31 this morning, Jerome Powell and the team down in Washington go, oops.
Growth is okay, but not as good as we thought it was.
Yeah, and you know, Lisa's going to tell us in the brief how many 8-9 Fed speakers today. But this thing at 8:30 today, dovetail, folks, your market trauma into what we see at 8:30 today.
And then we'll get our teeth into claims. And if claims come in and around 200K, Bramo, 201, the previous read, 215, the estimate this morning.
If we keep getting this kind of lack of response in the labor market, if it keeps staying strong, especially with all of the wage pressure that we see percolating out in the headlines and beyond, how much does this sort of keep this feeling that rates are going to be higher for longer, and that maybe, if anything, the Fed is underestimating how much it has to do to curtail inflation?
They're higher again this morning. Let's touch base with this market. Quick snapshot of things for you. Equity futures just turning positive in the last 10 minutes or so. We're positive on the S&P by 0.1%. There's your move in crude. We pull back just a little bit after briefly breaching 95, back to 93.46 on WTI. And there's your move in the bond market. Right now, 462.82, up a couple of basis points. High of the session, high of the cycle. Lisa, 464.27.
The highest going back to 2007. It's the pace of the moves, as people did say at one point they were buyers and now are just stepping back. They don't want to catch a falling knife. Today, John, I take your point about initial jobless claims. That is going to be the most important economic data of the day. At 8:30 a.m., we do also get the second quarter GDP. It is the third revision, and we may, Tom, to your point, get an upward revision. But initial jobless claims, if they keep coming in, basically nowheresville in terms of historical reference point. You can see they basically flatlined since the pandemic, or over the past 2 years in particular. How much do we get this feeling that this economy is much stronger than many people expected? Tom, you were asking about Fed speakers. We've got 4 of them. We have Chicago Fed President Austin Goolsbee, Fed Governor Lisa Cook. We also have Richmond Fed President Tom Barkin with our own Michael McKee. This, to me, is going to be really interesting. Not only Tom Barkin, because Mike McKee is always a wonderful interview, but 4 p.m. Fed Chair Jay Powell is going to be hosting a town hall with educators at a time where it's curious what his response to some of the market moves have been, right? I mean, is he going to comment on that, or is he going to talk about his education policy? I'm not sure, but at this point, I am curious if he weighs in.
On TV, bring up those 4 beautiful faces again. John, I think you were missing this. Steve Rasciuto yesterday of Mizuho was on fire.
What did he say?
And he really got emotional, and he said Jerome Powell is not Alan Greenspan. Basically, he alluded, not to put words in his mouth, that Jerome Powell doesn't have control of the debate.
He went that
Fed.
far.
Rashudo was wound up. I told the team to get a video block on that so you could steal it for your other property. But, you know, I want to make clear here, there's a debate here about the dynamics of the Fed. I make jokes about it, but you know what, Lisa, you're right. The Fed speakers
Some
matter.
people might say that was implied by the forecast and the difficulty, Lisa, he had in the news conference explaining it.
And I would say, yes, absolutely. Steve Rashudo also went on to say that the composition right now of the Fed does not give the market confidence that they really are have conviction to get inflation back down to 2%. After the bell, I'll finish up on this. Nike earnings, also BlackBerry and Vail Resorts. Maybe we'll get a sense of what the ski season will look like this year. Just saying for a friend. Nike earnings will be key, especially because consumer discretionary shares have fallen 10% in the past 2 weeks, but still are up. So how much do we start to see some of the weakness play through there?
Do you need new skis this year? I mean,
no, I got some pretty recently, thanks.
Oh, you bought some new skis?
No, not like a year ago.
Yeah, but you need a backup pair.
All right, let's move on.
We can move on. Just you pulled up the ski and we just thought we'd go
Well, you
there.
know, I'm always interested in what they do because, you know, there wasn't as much snow last year, so how they sort of, you know, fare that out. And it gets really crowded, so do you end up with these, like, package deals or not?
And the guy in front of you skis over your beautiful Rossignol Olympic skis. That happens.
As long as they don't crash into me, I'm good.
This becomes very personal for Bramo.
I know, this is really
on a
gone
daily basis.
downhill very quickly.
John Stolfus joins us now,
So to
Chief
speak.
Investment Strategist at Oppenheimer Asset Management. Excuse the pun, right? Okay. John, I missed 4,900 on the S&P 500 year-end is your forecast, sir. Can you tell me how much of a challenge you see coming from the bond market currently?
Well, I must say that most near term there is a challenge in terms of perception, but it is not really uncommon when you're going through the type of transition that we're going to, and then the seasonality that's involved in this month. You've got to consider that you're going to question, you know, how are we doing with that? But remember, we had a 4,400 target that we put in last December that a lot of people thought was very high, that was achieved, what was it, in June or July of this year. And that's when we addressed and moved our target higher. At the end of the day, Jonathan, what I think we have here, it's the end of free money, and we think it's a good thing because bond issuers have to pay for the privilege of borrowing money. Bond buyers get something in return, and it puts a chill, and I think that's what we're seeing. I think the gambling money is right now really trying to lobby the Fed to begin to go to an extended pause or actually cut rates, instead of going through this gauntlet that they've got to run through to get to close to that percent target.
John, we're staggering into October. It's like September didn't exist. It went by so fast. And my theme for the year, a year that's coming to a close, is the great zombie roll-up. You just alluded to it, that money costs something, and the zombies are going to get rolled up or go out of business or whatever. How do you play that on a sector basis? Do you buy the zombies or do you buy people removed from that debate?
Well, I buy people removed from that debate because my mandate is more conservative in the sense that it's involved in dividend stocks that grow their dividends faster than their peers. And on a global basis, the indices that we use are not the most speculative indices, but are more the traditional indices that we use for institutions. But that said, we think there's a tremendous appetite for distressed assets. And you've got to figure the distressed buyers usually in crises that we've experienced over the last 40 years actually never really satisfy their appetite for distress coming out of it. Because usually the Fed, the Fed's not infallible and make mistakes, but usually the basic mandate of the Fed really defines the fact that they will be successful.
John,
and so
at Bank of America, long ago, when you were with Robert Sinch there, you used to trip over the value line once a month. I mean, the value line folks was on the floor, and you trip over that puppy as you did your securities analysis. What are you actually studying right now in this bond and FX turmoil?
What we are really studying is the cause, looking at the effect, and recognizing from what we see, our view of it is that the Fed has been remarkably sensitive to the outcome of its practice, of its mandate, to the underlying economy. So, and then it's been helped out a lot by all the fiscal stimulus that created a bridge over troubled waters and a Fed funds hike cycle process. So, and then you have technology, whether it's advanced logistics, things that help companies, good companies, weather tough storms a lot better than they could in a much more primitive era. So we look at a lot of things, but most certainly we look at the economic data. We see slowing, quite evident here, but not surprising. But yet we don't see the economy falling off a cliff, Tom.
John, is your bullish call on stocks predicated on the idea that the Fed will cut rates next year?
It's based on the fact that I think the Fed is getting closer to the end of this cycle, which would likely mean an extended pause to get some assurance that Jerome Powell doesn't have to be worried about being recognized as another Arthur Burns. I think that's preeminent in his thinking. He wants his legacy to be a good one, and I think he's got a good chance for it. So we think probably you'll get cuts towards the end of next year, mostly because we would expect that the Fed will have been more successful than not at curbing inflation, putting it in check, and it will be time to probably bring it down some, because we think there's one more hike to the end of this year likely, and then probably a hike next year, maybe even two.
John, 4,900 on the S&P, given the potential for another hike this year and maybe even, what did you say, two next year?
Yeah, well, you know, Jonathan, we publish weekly in our report and in our monthly chart book two tables that show the performance of the market for maximum drawdowns and a variety of things, whether it's the Fed funds rate, whether it is the CPI, and it's all listed there. And our clients can look at that and discuss it with their advisors. And what we have found in my experience in 40 years in this business is stocks can actually go up when interest rates are higher. I mean, yes. Tom and I can remember during the period when Paul Volcker was hiking. Yes. I can remember speaking with clients who really thought the Fed would fail. Everybody always thinks the Fed is going to fail until it doesn't. But stocks were going up while you still had coupons available on Ginnie Maes that were anywhere from 11 to 12%.
Are you the official Oppenheimer cheerleader? Is that what that was?
This is a theory that nobody believes. John and I lived Volcker, okay? And trust me, I made some dumb decisions at that time. And I've said this, John, all year. You've heard it 47 times without a drink in my hand and 122 times with a beverage in my hand. Companies adjust. That's what's going to happen.
Yes, sir.
John Stolfus of Oppenheimer Asset Management. John, thank you. Companies adjusting, Tom. Can stocks adjust? Can valuations adjust? Given the multiple expansion we've had through the year so far.
Well, for a chosen few, we got way ahead. Look at the equal-weighted SPX, I believe, to a negative statistic yesterday afternoon. What I love there is Stolfus and his bridge over troubled waters. And, you know, that's a very good illusion for the stress people face now. Because, John, when you're down and out, and when you're on the street, when you're toxic,
Except like, brew, flashing.
No, this is yours.
When your toxic brew falls so hard on you.
Oh, dear Lord. I will just say this, that there is a real question about the liquidity backdrop as well, about where the money is going to come from to juice those stocks to that higher level.
There's a wall of money out there.
Okay, that's what people say. But what does that mean? If you can park it in 10-year treasuries and get 5% or almost 5%, if you can do that, what is the point of taking a moonshot risk on companies that are facing a lot of headwinds?
Selected companies, and the issue here, the most important thing this week, folks, is Mike Wilson sitting to my left going, I'm not in cash. Wilson's in the market while he's cautious.
Well, he is the chief equity strategist. I would hope that he's got some equity.
Well, that's a mandate, you know?
I would hope. Greg Valliere of AGF Investments is joining us next. Were you up night watching the debates? Is that what this was?
Oh, lay me
Okay. The latest on the debates up next.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bidenomics has failed. Wages are not keeping up with inflation. Auto workers and all American workers are feeling it. Families are struggling in this economy.
We need a totally new approach to China. We are going to have real hard power in the Indo-Pacific, like Reagan, to deter their ambitions. We're going to have economic independence from China.
What we need is to deliver economic growth in this country, unlock American energy, drill, frack, burn coal, embrace nuclear energy, put people back to work.
Former Vice President Mike Pence, Governor Ron DeSantis, Vivek Ramaswamy on the GOP presidential debate stage yesterday, targeting Bidenomics. We'll bring you some sound a little bit later from Nikki Haley as well. Greg Valliere of AGF Investments weighing in